Okay. So the next chapter which we are going to take up for revision is going to be audit reporting chapter. Very, very important chapter. Very conceptual. This is something which you're going to, this is the chapter where you have to learn the things not from only exam point of view. This is a chapter where it is so significant for us to learn this chapter even from the practical point of view. So that audit reporting chapter we are going to pick up now, and we are going to do a very good revision, very comprehensive revision of the concepts of audit reporting chapter. So first of all, let me give you the overall agenda here. What exactly is this chapter going to deal about? So guys, if you remember, till now we have covered various aspects relating to this auditing subject. But in that, if you remember, the ultimate objective of the auditor, this is just something which I have discussed at the beginning of this series. So the ultimate objective, ultimately what auditor is supposed to do, what is the final outcome of the entire process of the audit? So we all are aware that the ultimate outcome, the final output of the entire process of the auditor is to express an opinion, and how that auditor is required to express that opinion. So we all agree to the fact that as an auditor, your ultimate objective, once you have done, once we say audit has been completed only when you have expressed your opinion. So what do you mean by expression of opinion? How do you express that opinion? So when I say express the opinion, will the auditor come before the audience, come before the shareholders, take the mic and say it like this? I'm giving a so and so opinion. Can he say it like this? Can it be considered as valid expression of opinion? The answer is no, my dear students. So when I say the auditor's responsibility is to express that opinion has to be expressed in a written format. That opinion should be expressed in a written format. Why? Because unless something has been put on the paper, it will not have any validity. So similarly, the auditor is required to express that opinion. That opinion is not something which you can do it orally or something else. That opinion you are required to express it in the form of a written report. That written report which is containing the auditor's opinion, that we are going to call it as audit report. The report which is going to contain auditor's opinion, that is what something we are going to call it as what? Audit report. And this chapter audit reporting is something which is going to deal about, which is going to teach you, which is going to let you know how to prepare that audit report, what and all content should be there, what is the format, what different kinds of opinion, what and all paragraphs you have to include. So like that, all aspects relating to preparation of the audit report has been covered in this chapter, audit reporting. And when I say your ultimate objective is to give this audit report, sir, how will I prepare the audit report? Will I be permitted to, for example, say if I'm an auditor, if I have conducted audit of some entity, I have to prepare my audit report. So can I prepare my audit report according to my own format? Can I use my own language? Can I use my own terminology? Can I express the audit report in whatever format I want? No. So in order to prepare the audit report, how to prepare that audit report, a perfect guidance has been given here. And that guidance has been given in the form of SS700 series of the standards. SS700 series of the standards are the standards which have been dedicatedly talking about how to prepare that audit report. And that SS700 series of the standards also, we have specifically 4 standards: SS700, SS701, SS705 and SS706. These 4 are the specific standards which are exclusively going to talk about what will be the format of audit report, what will be the contents of audit report, how you are supposed to draft it, different kinds of opinion, different kind of paragraphs. All that comprehensive discussion has been given under this 700 series. That's what we are going to cover as a part of this particular chapter. Okay, so having given this basic intro, now I will try to directly go into my revision series. We will directly go and hit the concept. So first we will start our discussion with SA700. SA700 talks about various aspects, but first we will try to pick up what will be the contents of the auditor's report. That is going to be very, very important. So SA700 speaks about many things. Out of all that, what is the most important aspect from SA700 is what are going to be the contents of audit report. In your audit report, what and all contents you are supposed to include. So here we have this. So this is what audit report, this is what SA700 says. So as per SA700, your auditor's report should be in a writing format and your audit report should contain the following contents. Sir, what contents should be there? So if you see here, the list of contents has been given here. What are all that contents? We'll try to discuss about each and every content in a detailed manner. We'll try to discuss about each and every content in a detailed manner. See, this chapter in our usual classes, we explain it in a very practical manner where we take the help of the practical audit reports. I will make you learn. Actually, if you're my student from regular classes or UOB classes, you would have realized this fact. So we make this concept so clear, so damn clear that you learn the things conceptually, at the same time you learn the things in a very, very practical way. But anyhow, since we can't afford that much amount of time on the practicality, I will teach you the entire content. I will try to revise the entire content, which is important for your examination perspective. We will not go into the practicality side. So first and foremost content of the audit report is going to be title. You have to give an appropriate heading for the auditor's report. Generally, in the case of companies, in the case of statutory audits and all, the title is going to be independent auditor's report. Generally, the title is going to be what? Independent auditor's report. So generally, even if you download the audit reports also of any of the listed companies, you can find it freely on the websites of the respective companies. They will upload their annual report. So download their annual report. In that, you will be able to find one section, auditor's report. Just open that auditor's report and see it once. First, you will be able to find the title, and the title will be usually independent auditor's report. So like that, one heading you have to give. Then you have to mention addressee. See, basically, auditor's report is a document through which you are expressing your opinion, right? If I have to put it in very simple terms, audit report is a letter through which you are expressing your opinion. So when I say it is a letter, it should contain some addressee. Even in your audit report also, there should be some addressee. Sir, who should be that addressee? It depends on the legal form of your client. If your client is a company, you will address to the shareholders, to the members of the so-and-so company. If it is a partnership firm, you will address to the members of the partners of the partnership firm. If it is a LLP, then also you will address to partners. And if it is a sole proprietor, you will address to the concerned sole proprietor. So whatever it is, who will be the appropriate addressee? That depends upon the legal form of the client with whom you are doing the audit. So there will be title, there will be addressee. After that, see, the main objective why we are preparing the audit report is to express our opinion. So SA 700 also says first come to the point. First come to the point. So you are giving this audit report mainly to express your opinion, right? So first express the opinion, then whatever you wanted to say, you say. We want you to say so many things. So standard is saying we want you to include so many things in your audit report, but the main purpose why you are giving the auditor's report is to express your opinion, right? So first come to the point, express your opinion. Thereafter, you are required to speak about some things else. So the first and foremost paragraph, I will say title and address is not a paragraph actually. Those are something like introductory points. The first and foremost paragraph in the auditor's report is going to be auditor's opinion. You are required to express your opinion. Now we will talk about different kinds of opinion. Sir, what are different kinds of opinion? Let us try to have a quick understanding here. So as we all are aware, the auditor's opinion can be broadly divided into two categories. Even I have told you in the introduction also. So like any other opinion regarding any person, any object, anything in this world will broadly fall under two categories, either a positive opinion, negative opinion. Even auditor's opinion is also not an exception. It will be broadly divided into two categories. It could be either positive opinion or it could be a negative opinion. But being audit professionals, we should not make use of this layman terminology. We have to get used to the technical terminology. So what is a technical terminology? So opinion can be broadly divided into two categories. One is unmodified opinion and the other one is modified opinion. Opinion can be broadly divided into two categories where it could be unmodified opinion or modified opinion. The name itself says unmodified opinion. That means, see, I will tell you the logic behind the name later. Unmodified opinion, something which is positive opinion, where as an auditor, we all are aware, our main objective is to verify the financial information. So we have verified the financial information of our client, and in that financial information, we did not find anything wrong. We did not find financial statements as misleading. We felt that financial statements are giving true and fair view. No omissions are there. No misleading information is there. That means ultimately you are convinced that financial statements are giving a true and fair view. What you are convinced? You are completely convinced that financial statements are giving a true and fair view. You want to give completely positive opinion. You want to say that financial statements are giving a true and fair view. Then which opinion you will give? Unmodified opinion you will give. So there are other names for unmodified opinion. We also call it as unqualified opinion. What do we also call it? We also call it as unqualified opinion, or we can also call it as clean opinion also we can call it. And SA 700 says that in what circumstances you will give unmodified opinion is when you have obtained sufficient and appropriate audit evidence. When you have obtained sufficient and appropriate audit evidence. And on the basis of that, you have concluded that financial statements are free from material misstatements. When you have concluded that financial statements are free from material misstatement, and also you have concluded that financial statements are prepared as per applicable financial reporting framework. So when you will give unmodified opinion, when you have obtained sufficient and appropriate audit evidence, you have performed all your audit procedures, you have obtained sufficient and appropriate audit evidence, and on the basis of that audit evidence, you have concluded, that means you have confirmed that financial statements are free from material misstatements and financial statements are prepared as per applicable financial reporting framework. Basically, our two main objectives. So when you have obtained sufficient and appropriate audit evidence that our main two objectives are fulfilled, then we will give unmodified opinion. Sir, how to identify unmodified opinion? So what the standard has told is, if as an auditor you are giving an unmodified opinion, we are expecting you to use certain terminology. The standard did not excuse the chartered accountants to use a terminology whatever they want. What the standard has told is, if you have decided that you are going to give an unmodified opinion, then we will tell you terminology, only use the terminology. Sir, what kind of terminology has been permitted for us to use in case if we are giving an unmodified opinion? So standard says either use the phrase financial statements give true and fair view. Either use this phrase or use the phrase financial statements present fairly, or use the phrase financial statements present fairly in all material respects. In all material respects, and they give the true and fair view. Okay, see here, drafting is very, very important. Drafting, the paragraph drafting is very, very important. So I would suggest you, even in the question bank, you will be able to find various questions regarding drafting. Draft an opinion paragraph, draft the basis for opinion paragraph, draft the management responsibility paragraphs. So many questions will be there. So just have a look at that. Illustrations, you have a look, so that in the recent times they're asking the questions regarding drafting, how to draft the paragraphs. So please have a look at that once. So whatever it is, if as an auditor you have decided to give unmodified opinion, the standard is permitting you to use one of these two phrases. Either use the phrase financial statements give true and fair view, or use the phrase financial statements present fairly in all material respects. One of these two phrases is only permitted, nothing more. Clear? So the moment you find these phrases, what kind of opinion it is? It is an unmodified opinion. Okay, right. Sir, when auditor will give modified opinion? See, when you are fully convinced that financial statements are giving a true and fair view, you are going to give unmodified opinion. That means when you will give modified opinion, see, when I am not fully convinced with the true and fair view of financial statements, I have some negative remark regarding the financial statements which are prepared by the management. So in case if you have decided that financial statements are not completely giving a true and fair view, then you are supposed to give a modified opinion. Now, coming to the modified opinion, these modified opinion can be of three broad categories. Modified opinion can be of how many categories? Modified opinion can be of three categories. Sir, what are that three categories of modified opinion? Number one is qualified opinion. Number two, adverse opinion. Number three, disclaimer of opinion. So if the auditor has decided he wanted to give a modified opinion, that modified opinion can be given in three categories. So what are the three categories of modified opinion? Either you can give a qualified opinion, or you can give a adverse opinion, or you can give a disclaimer of opinion. See, all the three are different kinds of modified opinion only. So now we have to understand when we will give modified opinion, when we will give qualified, when we will give adverse, when we will give disclaimer. Each and everything we'll try to understand it in a detailed manner. Okay, listen carefully. See, qualified opinion can be given in two cases. Qualified opinion can be given in how many cases? Two cases. So what are the two cases? Auditor has obtained sufficient and appropriate audit evidence. Sufficient and appropriate audit evidence is available. You are able to perform audit procedures. You have obtained sufficient and appropriate audit evidence. On the basis of that sufficient and appropriate audit evidence, you have concluded that financial statements contain misstatement. What you have concluded? Financial statements is containing a what? Misstatement. And the effect of the misstatement is material. Whatever misstatement you have identified, that is material. That is significant enough to influence the economic decision of users of the financial statements. But that misstatement is not pervasive. That misstatement is what? Not pervasive. I will tell you what do you mean. What is the meaning of the term pervasive? I will tell you. So for the time being now, you remember it as the misstatement is, if the misstatement is so big enough to say financial statements are completely wrong, that misstatement we call it as pervasive. Very, very big amount of misstatement. Very, very big misstatement, you can say it. So if the misstatement is very, very big, then we call it as pervasive misstatement. But when I will give qualified opinion, as you could see here, I have obtained sufficient and appropriate audit evidence. On the basis of that, I have concluded that financial statements contain a misstatement, and the effect of the misstatement is only material but not pervasive. Then we will give what? Qualified opinion. There is one more case where we can give qualified opinion. Sir, what is that one more case? Sufficient and appropriate audit evidence is not available. That means some audit procedures you are unable to perform. You are unable to perform some audit procedures. You are unable to obtain sufficient and appropriate audit evidence. And those items regarding which you are unable to obtain sufficient and appropriate audit evidence, the possible effect, very, very important, guys. The terminology is very important here. Possible effect. There is a possible effect to that. See, there are some items for which you are unable to obtain audit evidence. And there is a possibility that that could be a mistake. There is a possible effect of misstatement is there. Whatever items which I am unable to obtain audit evidence, since I am unable to obtain audit evidence, there is always a possibility that that items can go wrong. So you are unable to obtain sufficient and appropriate audit evidence regarding certain items of the financial statements. The possible effect, if those items regarding which I am unable to get the evidence, if those items goes wrong, the possible effect of that misstatement, the possible effect of misstatement is what? Here also they say the possible effect of the misstatement is only material. The possible effect of the misstatement is what? Material. But the possible effect of the misstatement is not pervasive. The possible effect of the misstatement is not pervasive. So very simply, if I have to put it, qualified opinion can be given in two cases. Number one, sufficient and appropriate audit evidence. You have obtained sufficient and appropriate audit evidence. Second case, where you are unable to obtain sufficient and appropriate audit evidence. But the effect or possible effect of the misstatement, when evidence is available, we will directly say the effect. So when the evidence is not available, we say possible effect because we don't know. So whether you have evidence or you don't have evidence, but the effect or possible effect of the misstatement should be only material, but it should not be pervasive. It should not be a very big misstatement. It is material, agreed. It is not a very big misstatement. It is not a pervasive misstatement. Then we will give qualified opinion. Sir, in case if the auditor is giving a qualified opinion, what kind of phrase he has to use? What kind of phrase he has to use? He has to use the phrases except. So you will find the phrases in the opinion paragraph something like this: except or subject to certain items. So because of what items, because of either what if misstatement you have found out, what effect of the misstatements, or if you are unable to find out the audit evidence, what is the possible effect of the misstatements? That effect you will explain. Effect or possible effect you will explain. So except or subject to effect or possible effect of the certain items, financial statements give a true and fair view. What phrase I will use? I will say except or subject to certain items, except or subject to effects or possible effects of the items, financial statements give a true and fair view. That means here it is not a completely positive opinion. Here it is not a completely negative opinion. Here I am adding a slight negative remark. See, frankly speaking, qualified, adverse, disclaimer, all these three are negative opinions only. But severity of the negative remark is changing. So qualified opinion is also a negative opinion only. But the severity of the negative remark which I am giving is comparatively lower than when compared with the other two kinds of modified opinion. And in case if you are giving qualified opinion, what phrase you have to use? Except or subject to effect or possible effect of the misstatements, the financial statements give it true and fair view. There is a problem with a few items, rest of the items are giving it true and fair view. So if you see here, it is not a completely positive remark. Here I have attached one slight negative remark, right? So this is when you will give qualified. Sir, when auditor will give adverse opinion, if you are conducting audit of an entity, when you will give adverse opinion, adverse means something which is completely negative, complete negative opinion. So when generally auditor will give adverse opinion is you have obtained sufficient and appropriate audit evidence. You have obtained what? Sufficient and appropriate audit evidence. You are able to perform audit procedures. You have sufficient, you have pakka audit evidence, sufficient and appropriate audit evidence you have. On the basis of that evidence, you have concluded that financial statements contain a misstatement. You have perfect evidence. On the basis of that evidence, you have concluded that financial statements are containing a misstatement. And what is the effect of the misstatement? You have concluded that the effect of the misstatement is not just material, it is also pervasive. What you have concluded, my dear students? So on the basis of whatever evidence you have obtained, you concluded that financial statements are containing a misstatement. There is a clear-cut evidence that financial statements contain a misstatement. And what is the effect of that also? It is not just a material, it is a very big amount of misstatement. It is a very big misstatement also. So you have obtained sufficient and appropriate audit evidence, and on that basis you have concluded that financial statements contain a misstatement whose effect is not just a material and it is also pervasive. Sir, what kind of terminology I have to use if I'm giving an adverse opinion? The standard says straight away say it. Financial statements do not give true and fair view. Straight away say it. Completely negative. I'm saying these financial statements are completely wrong. Financial statements do not give true and fair view. Straight away you can use this phrase here. Able to understand? So this is the one case. Oh, there is only one case where I will give adverse opinion. You are saying something is completely wrong. Financial statements are completely negative. Financial statements are not giving true and fair view. And one important thing here, I can say something as completely wrong only when I have sufficient and appropriate audit evidence. So that's why the one of the prerequisite for giving adverse opinion is that you have a sufficient and appropriate audit evidence. So you have sufficient and appropriate audit evidence. You concluded that financial statement contain a misstatement whose effect is not just material, it is also pervasive. Sir, when I will give disclaimer of opinion? Sir, what is the meaning of the term disclaimer? Generally, disclaimer means stopping yourself from doing something. If you are stopping yourself or if you are giving a caution, that is what we call it as disclaimer. So when auditor will give disclaimer, in what kind of circumstances auditor will give disclaimer? Auditor is unable to obtain sufficient and appropriate evidence. Auditor is unable to obtain sufficient and appropriate audit evidence. Auditor is unable to perform audit procedures. He is unable to obtain sufficient and appropriate audit evidence. And the possible effects of those undetected misstatements. These terminologies are very important, my dear students. Possible effect of that undetected misstatements. That means there are so many items regarding which I am unable to obtain audit evidence. Like for assets, I am unable to obtain evidence. For liabilities, I am unable to obtain evidence. For incomes, I am unable to obtain evidence. So for so many items, I am unable to obtain evidence. Whatever items which I am unable to obtain evidence, if those items have gone wrong, what could be the possible effect? So possible effect of undetected misstatement. See, wherever you are using possible effect, there you have to replace the misstatement with undetected misstatement. Here I have missed it out. Undetected. Why? Because I'm unable to detect. No, I'm unable to perform audit procedures. So I'm unable to obtain sufficient and appropriate audit evidence. And the possible effect of undetected misstatements. What is the possible effect of undetected misstatements here? Here also it is material. Definitely the possible effect is material, but it is not just material, it is also pervasive. So simply, if I have to put it in a very layman terms, I am unable to obtain sufficient and appropriate audit evidence regarding so many items, and if those items go wrong, the possible effect is not just material, it is going to be very, very big amount of misstatement. It is having a potential. So then the auditor will give disclaimer of opinion. And when the auditor gives a disclaimer of opinion, the terminology which is the standard is permitting him to use it, directly use the phrase, we do not express an opinion. What terminology he can use? We do not express an opinion on the financial statements. So since we are unable to obtain sufficient and appropriate audit evidence, we are unable to express, or we do not express an opinion on the financial statements. Straight away say that you are unable to express an opinion. So that is what the third kind of disclaimer of the third kind of modified opinion, which is a disclaimer of opinion. So like this, when the auditor is not completely satisfied with the true and fair view of the financial statements, he can give modified opinion. There are three ways in which auditor can modify his opinion. Either he can give qualified opinion, or he can give adverse opinion, or he can give disclaimer of opinion. As I have mentioned, once again, I'm repeating my statement, qualified, adverse, disclaimer, all the three are some negative comments only, but in each of the case, severity of the negative comment is changing. What is changing? The severity of the negative comment is changing. Some modified opinions are more severe, some modified opinions are less severe. Like if you pay close attention here, adverse and disclaimer are more severe modified opinions, whereas qualified is a less severe modified opinion. Clear? Able to understand here? Right. So now one important thing we have to understand. Sir, you are saying, you are continuously said throughout the definitions of the modified opinion, you have used the phrase pervasive, pervasive. You are telling misstatement is pervasive, misstatement is not pervasive. You all will get a doubt. Sir, when can a misstatement be called as pervasive? You told, in simple terms, you told that very big misstatement, but that is not what the technical meaning which has been technically, that is not how the term pervasive has been defined. There is one technical definition associated with the term pervasive. When we can call a misstatement as pervasive, that definition has been given. So let us try to go through. That definition was actually given in SA 705. Not just that definition, whatever different types of modified opinion we have understood till now, whatever different types of modified opinion like qualified, adverse, disclaimer, how to modify, when to modify, all that discussion has been taken from SA 705. So when I was explaining this different kinds of modified opinion, actually I have diverted from SA 700 and have gone to SA 705 and made you understand different kinds of modified opinion. So what we will try to do is, since we have come across this term pervasive, let us try to understand when a misstatement can be considered as pervasive. Very, very important from the examination point of view, my dear students. So let us try to have a quick look at it. So when a misstatement can be called as pervasive. So let us see. Pervasive. Generally, we use this term. Pervasive is a term which is used in the context of what? Misstatements. Either to describe the effects on the financial statements or to describe the possible effects of the undetected misstatements. If you are able to identify a misstatement, to determine its effect also we use the term pervasive. If you are unable to identify the misstatement, then to determine the possible effect also we use the term pervasive. So the term pervasive is used in the context of misstatement either to explain the effect of the identified misstatement or possible effect of the undetected misstatement. And when we can generally call that misstatement as pervasive is, number one, pervasive effects on the financial statements are those that in the auditor's judgment are not confined to specific elements, accounts or items of the financial statements. So if the misstatement is not just restricted to one item, if the misstatement is spread across so many items, then we call that misstatement as pervasive. Like once again, simple example, whatever example I have used, we'll take the help of that. So let us say, for example, you are conducting audit of the financial statements. There are different items. Let us say balance sheet, you are conducting the audit. Fixed assets are there. Current assets are there. Then we have equity, and that is share capital. We have reserves and surpluses. We have long-term borrowings. We have short-term borrowings. We have. So if you are able to find a misstatement in fixed assets also, you are able to find a misstatement in current assets also, you are able to find some misstatement in the short share capital also, you are able to find some misstatement in the short-term borrowings also. So here, if you pay close attention, misstatement is not just restricted to one or two items. Misstatement is spread across. If it is not confined means what? If it is not restricted to one or two items, it is spread across multiple items, then we can call that misstatement as pervasive. Here I can call that misstatements as pervasive. Or what else they say here is, sometimes a misstatement will be confined only to one or two items. In the first point they told, if the misstatement is not confined to specific items, then we call it as pervasive. Now they say that in some cases, misstatement will be confined. It will be restricted to only one or two items, but it could represent a substantial portion of the financial statements. Sir, what do you mean by this? So let us say, for example, you are conducting audit of some entity. Once again, financial statements are there. Balance sheet is there. In the balance sheet, you have fixed assets, current assets. You have fixed assets are some 100 crores. In the current assets, you have different items. You have something inventory 50, trade receivables 30, cash and cash equivalents 20, total 200 crores of assets you have. Now you are able to find a misstatement only in fixed assets. Here it is correct, here it is correct, everything is correct. You are able to find misstatement only in fixed assets, but the amount of the misstatement is 80 CR amount of misstatement you are able to find. So misstatement is confined to only one item. Like in the previous case, it is not spread across multiple items. It is restricted to only one item. But the amount is so big, even though the misstatement is confined to single item, it could represent a substantial portion. The total balance sheet itself is 200. In that 80 crores of misstatement is there in a single item. Here also we can call it as pervasive. So a misstatement can be considered as pervasive even though if it is confined or restricted, it could represent a substantial portion. Or in relation to those disclosures which are fundamental to users' understanding of the financial statements. Which means if the management has made a misstatement in disclosures, in the notes to accounts, and in respect of those notes to accounts, which are very fundamental to users' understanding, like management made a mistake in the going concern disclosure, management made a wrong disclosure regarding fundamental accounting assumptions. So even if the management made misstatement in relation to disclosures, which are very much fundamental to users' understanding, then also we call it as pervasive. So here also one important point I have to highlight here, which I have highlighted even at the beginning also. So generally when we say misstatement, we generally imagine the misstatement in terms of numbers, misstatement in P&L, misstatement in balance sheet, misstatement of cash flow, which need not be always, my dear students. The misstatement need not be always in figures. The misstatement could be even in notes to accounts also. And in the notes to accounts, not just an ordinary misstatement, even a pervasive misstatement can happen in the notes to accounts. Clear, everybody? So this term, the meaning of the term pervasive is going to be very, very, very important, my dear students. Clear, everyone? Right. So from where we have come till here, tell me. So what we are actually discussing, we have actually started discussing SA 700, which is speaking about what and all will be the contents of the auditor's report. There we have taken up each and every content. There we have started taking up one by one contents, and we have started understanding. In that, first we have understood what is title, then we have understood what is addressee paragraph, what is the auditor's opinion. And as a part of that auditor's opinion, we have understood different kinds of opinion, unmodified, modified, different kinds of modified. Along with that, we have understood along with that, what also we have understood? We have also understood this small thing called pervasive. The discussion regarding opinion paragraph is not yet over. We have still a few more things which are required to be discussed. See, generally in the auditor's opinion paragraph, we will express our opinion. In the auditor's opinion paragraph, we will express our opinion. So just give me 1 minute. I will show with you any audit report on this one. Just give me 1 minute. Just one audit report I will show so that we will have a clarity. So I have downloaded one audit report for you. So whatever you are looking at here is, this is actually the audit report of the Reliance Industries Limited for the financial year 24-25. So as you could see here, for just a quick overview, so you're able to find the title here, which is Independent Auditor's Report. Then you're able to find the addressee here, as I have told, as we have seen as per SS 700. So first there will be title, then there will be addressee, then there comes the opinion paragraph. Now, if you come to the opinion paragraph, you look at any audit report, this is going to be common. In the opinion paragraph, you will be able to find two subparagraphs. So in the second subparagraph, it is going to talk about the main opinion. Like we have discussed, unmodified, modified, and in the modified also qualified, adverse, disclaimer. So what opinion auditor is going to give on the financial statements, that will be covered in the second subparagraph. Now, every audit report you find it, in addition to the main opinion, the auditor also will try to say some extra information in the opinion paragraph. So what is that extra information which auditor is saying in the opinion paragraph along with the opinion, whatever he is giving? So anyhow, he is mainly saying his opinion, what opinion he is going to give. In addition to that, some extra information also is required to include in the auditor's report in the opinion paragraph. Sir, what is that extra information which he is required to include? So as per SS 700, there are 5 matters which must be included in your opinion paragraph along with the opinion whatever you are giving. So what are that 5 matters, sir, which must be included under the heading opinion? So those 5 matters are: number 1, identify the entity whose financial statements have been audited. Simply, if I have to put it, mention the name of the organization. So identify the name of the entity whose financial statements you are conducting the audit. Mention the name of the client. And you have to mention a statement that financial statements have been audited. You have to expressly state that whatever financial statements of this client are there, they have been audited. And identify the title of each statement comprising the financial statements. So in the financial statements, what and all components are there? Their titles also you have to say, like this financial statements include balance sheet. This financial statement include statement of P&L. This financial statements include statement of cash flows. So identify the title of each statement comprising financial statements. Refer to the notes including the summary of significant policies. Even give a reference that these financial statements include even notes to accounts also, which contains a summary of significant accounting policies. Not just that, even refer to the date and the period covered by the financial statements for which you have done the audit. So mandatory, my dear students, along with the opinion, whatever you are giving, these 5 items also must be included in the opinion paragraph. Now, okay, so with that, we have completed opinion paragraph. So after the opinion paragraph, the next content which you have to include in your audit report is basis for opinion paragraph. Okay, in the opinion paragraph, you are sharing your opinion. What is your opinion on the financial statements? You are sharing. But why should anybody believe your opinion? Why should anybody believe your opinion? So if you let the users know on what basis you are giving that opinion, then the readers will have a confidence and the readers will be able to rely on your opinion. So you have to let them know a brief on what basis you have given your opinion. So what exactly I will state in the basis for opinion paragraph, sir? What exactly I will state in the basis for opinion paragraph? So they say that in the basis for opinion paragraph, 4 items must be included. 4 lines should come. 4 things should come. What are they? Number 1, you should state that audit was conducted in accordance with the standards on audit. So you have to let the users know that you are not doing the audit as per your own choices. You are in fact doing the audit as per standards on auditing. And also refer to a section of the auditor's report that describes auditor's responsibility. That means give a reference to auditor's responsibility paragraph. So if you come back to the contents here, you will be able to find something called auditor's responsibility paragraph. In this responsibility, we include all responsibilities as an auditor. From the beginning till the end of the audit, what and all are our responsibilities? All that responsibilities will mention. In which paragraph? In the auditor's responsibility paragraph. So that reference where you have to give, that reference you have to give it in the basis for opinion paragraph. That means in the basis for opinion paragraph, you have to say that we have so many responsibilities and our responsibilities have been included in the auditor's responsibility paragraph. That reference you have to give. Next, include a statement that auditor is independent. Mention that you are independent of the entity and you are also complied with ethical requirements and also you have fulfilled all your ethical responsibilities. Mention that you are independent, you are complying with ethical requirements and you are fulfilling all your ethical responsibilities. And also state whether the auditor believes that audit evidence that the auditor has obtained is sufficient and appropriate. Also mention that whatever evidence you have obtained, is it sufficient and appropriate or not. So these four things must come in my which paragraph? Basis for opinion paragraph. So simply if I have to put it, now one important point I'm going to say it here. So you will give opinion paragraph. In the opinion paragraph, you will mention 5 things. Along with that, your opinion you will give. Then you will come to basis for opinion paragraph. In that basis for opinion paragraph, whatever 4 points I have stated now, those 4 points you will include. Now, this is what you are supposed to do in the case of unmodified opinion. In the case of unmodified opinion, this is what the limited information you will give in the opinion paragraph and basis for opinion paragraph. In case if you are giving a modified opinion, in case if you are giving a modified opinion, when I say modified opinion, it could include qualified also, adverse also, disclaimer also, any of the modified opinion. So if you are giving unmodified opinion, your opinion and basis for opinion paragraph will contain very, very limited information like whatever we have seen now. But in case if you are giving a modified opinion, either qualified, adverse or disclaimer, then the opinion paragraph and basis for opinion paragraph will undergo some changes. Very, very important discussion, my dear students. So if you are giving a modified opinion, our opinion paragraph and basis for opinion paragraph must undergo some changes. Sir, what are that changes? First, title should change. Title in the sense, heading should change. I will not keep it title, you will get confused. Headings will change. So if you are giving unmodified opinion paragraph will title will just remain opinion. Basis for opinion paragraph, heading will remain basis for opinion. But in case if you are giving qualified, adverse or disclaimer, let us say for example, if you are giving qualified opinion paragraph heading should be changed to qualified opinion and basis for opinion paragraph should be changed to basis for qualified opinion. If you are giving adverse opinion paragraph heading should be changed to adverse opinion, basis for opinion should be changed to basis for adverse opinion. Same thing will apply for even disclaimer of opinion also. So opinion title should be changed to disclaimer of opinion and basis for disclaimer of opinion you are supposed to change. So first thing, headings should change. Number 2, second thing which should change is, so in the basis for opinion paragraph, in the basis for modified opinion paragraph, you will mention these 4 things, that 4 basic things like you are doing the audit as per standards, you comply with ethical requirements, that 4 basic things will come. In addition to that 4 things, reasons why you are giving a modified opinion, that could be either qualified, adverse, disclaimer, because of what reasons you are giving a modified opinion, those reasons also require to be explained in the basis for opinion paragraph. When guys, when you are giving a modified opinion. So we will change the title. Along with that, in the basis for opinion paragraph, basis for opinion paragraph will undergo numerous changes in case if you are giving modified opinion. And if you have to summarize that change in single line because of whatever reasons you are giving a modified opinion, that reasons also you are required to include in the basis for modified opinion paragraph. Sir, what exactly are the changes which I have to make in case if I am giving a modified opinion to my basis for opinion paragraph? To know that, once again we have to go to SA 705. So let us go to SA 705 and see what changes we are required to make to our basis for opinion paragraph. So where is it? Right. Here it is. So form and content of the auditor's report when the opinion is modified. As I have told, opinion paragraph and basis for opinion paragraph headings will change. Now, especially in the basis for opinion paragraph, what you should do. Here also you have to change the heading. Basis for opinion to basis for qualified opinion, basis for adverse opinion, basis for disclaimer of opinion. Next. And within that basis for opinion paragraph, you have to include a description of the matter giving rise to modification. Because of what reason you are modifying your opinion, that you have to explain in a detailed manner. Sir, what exactly I have to describe? So you are saying because of what reasons I am giving a modified opinion, that I have to describe it. But how, sir? That guidance also they have given it here. So if there is a material misstatement relating to amounts, if you are modifying your opinion because some amounts are misstated, figures are misstated, then the auditor shall include in the basis for opinion a description and a quantification also. Just saying that misstatement is there in so and so item alone will not be enough. Even you have to quantify amount of the misstatement also you have to include in the basis for opinion paragraph. Let us say if I found that in the purchases there is a misstatement, that's why I'm giving modified opinion. And in the basis for modified opinion paragraph, if you just say there is a misstatement in the purchases alone, it will not be enough. Even you have to tell what is the amount of that misstatement, quantification you are required to do, unless it is impracticable. If it is highly impracticable for you to determine the amount of the misstatement, you can ignore. To the extent possible, you have to quantify the amount of the misstatement and include that amount. If not practicable to quantify, mention the same. If it is highly impracticable, say that it is impracticable for you. You are unable to determine that amount of misstatement. Next, in case if you are modifying your opinion because of narrative disclosure, as I have told, misstatement need not be always in figures. Misstatement can also be in notes to accounts. So in case if you are modifying your opinion, and why you are modifying your opinion is not because of any amount there is a misstatement, there is a narrative disclosure. Whatever explanation they have given in the notes to accounts, their misstatement is there. That's why you are modifying opinion. In that case, you have to include in the basis for opinion paragraph how that disclosures are misstated. What wrong explanation management has given. Explain it. Don't just say so and so note has been misstated. No, mention what wrong things they have done in that explanation. Next, in case if you are modifying your opinion due to non-disclosure, see, sometimes management might not give the actual disclosure, then also you can modify. So if you are modifying your opinion because of non-disclosure, discuss that non-disclosure. First, to go and discuss that non-disclosure with the top level management, with those charged with governance. Describe in the basis for opinion paragraph what kind of information has been omitted. Let us say, for example, management did not give some disclosure regarding fixed assets. That's why you are modifying. First, what I will do, discuss with those charged with governance. Then mention in your audit report in the basis for opinion paragraph, say that a disclosure regarding fixed assets has not been given. That alone will not be enough. Unless prohibited by law or regulation, include omitted disclosure. Whatever disclosure management has omitted to give, that disclosure you give it in your auditor's report, unless prohibited by law or regulation. If there is a restriction in law and regulation to not give disclosure, don't do it. If it is not prohibited by law and regulation, whatever disclosure management has omitted, that you include in your audit report. Able to understand, my dear students? So if you are modifying your opinion due to non-disclosure, first discuss with those charged with governance, and in the basis for opinion section, tell what nature of that omission, unless prohibited by law or regulation, include that omitted disclosure also. Similarly, you can also modify your opinion because you might not be able to obtain sufficient and appropriate audit evidence. As we have seen, if you are unable to obtain sufficient and appropriate audit evidence, then also you can modify. Or then also either you can give qualified or disclaimer, right? So in case if you are modifying your opinion because you are unable to obtain sufficient and appropriate audit evidence, include in the basis for opinion what are the reasons, what has caused you not to obtain that audit evidence. Explain that. Next, if the auditor expresses qualified or adverse opinion, the auditor shall amend whether audit evidence obtained is sufficient and appropriate. Nothing but in the basis for opinion paragraph, there will be fourth content, right? There will be what am I doing? So here, if you come back once again to the basis for opinion paragraph, if you come to the opinion SA 700, in the basis for opinion, you will have one paragraph, right? D point, state whether auditor believes that audit evidence obtained is sufficient and appropriate. This line you have to add it even for qualified or adverse opinion also. Why? Because in the qualified and adverse opinion also we will have our sufficient and appropriate audit evidence, right? But in case if you are giving disclaimer of opinion, you need not state this. In case if you are giving disclaimer of opinion, this point will not come. Why this point will not come? Why? Because you are unable to obtain sufficient and appropriate audit evidence. No, that's why you are giving disclaimer. No, then how can you say that you have obtained sufficient and appropriate audit evidence? Able to understand? So very logical, my dear students. This discussion is going to be damn logical, very connected. In the usual class now, we enjoy this topic like anything. This connectivity is very beautiful. Like as if you see here, when auditor disclaims an opinion on the financial statements, the auditor's report shall not include the following elements. That means particularly if you are giving a disclaimer of opinion in the basis for opinion in the basis for opinion paragraph, some things should not come. What should not come? As I have told, a statement about whether audit evidence is sufficient and appropriate, that should not come. And also you need not give reference to auditor's responsibilities. So this paragraph is very, very important, my dear students. Whatever we have understood here, that is very important. So if I try to summarize it here, in case if you are giving it this, they will specifically ask this. If as an auditor you are modifying your opinion, and in case if you are giving disclaimer of opinion, what changes you are required to make for basis for opinion paragraph? In case if you are giving disclaimer of opinion, what changes you are required to make to the basis for opinion paragraph? Very important question. Number one, we will change the title. And one more thing, what we will do is, in case if we are giving disclaimer, in our audit report, this point should not come. In the basis for opinion paragraph, this point should not come. Last point also should not come. You need not include reference to auditor's responsibilities. You also should not say whether the auditor has obtained sufficient and appropriate audit evidence. That means if you are giving disclaimer of opinion in the basis for opinion paragraph, only two things will come. State that audit was conducted in accordance with the standards on audit, and also state that you are independent of the entity, you complied with ethical requirements, and you fulfilled all your ethical responsibilities. These 2 points should not come. B and D should not come in the basis for opinion paragraph. Why? Because you are unable to obtain sufficient and appropriate audit evidence. B point you will get to know later. Anyhow, let me tell you now why they are asking you not to give reference to auditor's responsibility is because when we give disclaimer of opinion, even auditor's responsibility paragraph also will be very, very limited. Very small information will be there in the auditor's responsibilities when you give disclaimer of opinion. That's why you should not give any reference to auditor's responsibilities. Anyhow, we will see what changes will happen to auditor's responsibility when you give disclaimer of opinion. Clear? So this is what regarding basis for opinion paragraph. Very important discussion what we had is what changes you will be making to basis for opinion paragraph in case if you give modified opinion. That is very important discussion. The thing which we have just now covered, very, very important from the examination perspective. From there, they can ask MCQs, multiple case scenario based MCQs they can create. Okay, right. So now once again we are discussing the contents, right? So let us come back to the contents. So we have completed only 4 contents till now. So title we have completed. Then there should be addressee, there should be auditor's opinion, then there should be basis for opinion paragraph. In addition to that, in your audit report, you will have something called going concern. In some cases, you will get one paragraph relating to going concern. Sir, what is this going concern paragraph? This we will try to revise it when we take up SA 570. Not now. So what is this going concern paragraph? What kind of information will come in this going concern paragraph? That we will get to know about it when we take up the standard SA 570 for discussion. Not now. Then we have something called key audit matter. Key audit matters paragraph we have that we will try to learn it in SA 701. In SA 701. See, first we will complete 700, 705. Quickly we will try to complete 700, 705. After that, we will take up 701 and 706. So at the time of explaining 701, we will get to know what is key audit matter paragraph. We will have a dedicated discussion. Then you will have something called other information. This is something related to SA 720, which we will not discuss it at the CA inter level, that we will discuss at the CA final level. This is something which is out of syllabus. So just remember that there will be a paragraph called other information, but what exactly will come there, we will learn it at the CA final level. Then we have, in addition to that, we will also have 2 paragraphs. Emphasis of matter paragraph will be there. Other matter paragraph also will be there, that we will get to know about it in SA 706. Okay, right. So leaving out all that, in addition to all these paragraphs, now one more general content which will come in your auditor's report is responsibilities for the financial statements. Like this one paragraph should come. Now what is this paragraph is? In this paragraph, you have to explain what are the responsibilities of the management. What are the responsibilities of the management regarding the preparation of the financial statements? So this going concern, you ignore it. This will be covered automatically when we take up SA 570. For the time being, you ignore it. So key audit matters also will have a dedicated discussion. Other information, as I have told, SA 720 will discuss at the final level. Now come to this paragraph, responsibilities for the financial statements. Basically, like the way we are including audit management responsibilities in the engagement letter, even in the auditor's report also, SA 700 has asked the auditor to include what are the responsibilities of the management. And particularly in this paragraph, what content will come is, so in that auditor's report, you have to include one paragraph with the heading responsibilities of management for financial statements. So which responsibilities I have to say? Very simple. You have to say in that paragraph that management is responsible for preparation of financial statements. That too in accordance with what? Applicable financial reporting framework. Not just that, they are also responsible for implementation of internal controls to make sure that financial statements are free from material misstatements. So simply, they are responsible for preparation of financial statements, for implementing internal control. And they are also responsible for assessing entity's ability to continue as a going concern. You should also mention, you should also say that one of the responsibility of the management is to assess whether entity is able to continue as a going concern, whether going concern assumption is valid or not, whether entity will continue as a going concern or not. Doing that assessment is also whose responsibility? Management responsibility. Tell it in the management responsibility paragraph. In addition to that, you should also include in the management responsibility paragraph who is responsible for oversight of the financial reporting process. So who in the organization is having oversight? That means who in the organization is looking after the financial reporting process. Those people also have to identify. Specifically, if there are those charged with governance, they are looking after the financial reporting process. Identify that, those charged with governance. So simple 3 points should come in my management responsibility paragraph, my dear students. They're responsible for preparing financial statements, implementing internal control. They're responsible for making an assessment regarding going concern, and who is responsible for oversight of financial reporting process. These are 3 points should come. Now the standard says immediately after the management responsibilities, you should also include one more paragraph where you have to explain what are auditors' responsibilities also. So just when you are explaining management responsibilities, why to hide auditors' responsibilities? So even include all the auditors' responsibilities. So this paragraph is going to be very, very lengthy here, not that important from the examination perspective. Just I will try to briefly take you through what kind of responsibilities you have to include in the auditor's responsibility paragraph. Like you have to say what are your objectives. Like we know our objective is to obtain reasonable assurance, and also we have to give audit report. Tell the users that reasonable assurance is a high level of assurance, but it is not a guarantee. Tell the users that misstatement can arise from fraud or error, but you will not be concerned with each and every misstatement. You will be concerned with only those misstatements which are material, which are expected to influence the economic decision of users of the financial statements. And also define what is a materiality. Then, in addition to that, you should also say that you are required to exercise your professional judgment. You have a responsibility to maintain professional skepticism, which you have discussed in the previous chapter. And even further state that you are responsible to identify and assess the risk of material misstatement. And also, you are required to perform audit procedures. And also you have to say that you are responsible for obtaining understanding of internal control. You are responsible for evaluating appropriateness of going accounting policies. You are responsible to assess the management's use of going concern assumption, whether management has made correct assessment regarding going concern assumption or not. That is your checking. That is your responsibility. And also, in case if the financial statements are prepared as per fair presentation framework, check whether they are achieving a fair presentation or not. Not just that, this SA 600 is related. In case if you are using the other auditors' work, tell that also division of responsibility, how the responsibility has been divided. And also mention that you are responsible to communicate certain matters with those charged with governance. What are that matters which are required to be communicated with those charged with governance? That we'll try to discuss in SA 260 and 265. And also state that and also have a responsibility to communicate with those charged with governance regarding compliance with ethical requirements in case of listed entities. And also if you have any key audit matters, those are also required to be communicated. So these are all communication. That means basically auditor is having some communication requirements with those charged with governance. Sir, what are that communication requirements? This you need not study here separately. All these communication requirements will be covered in respective standards. So when we take up SA 260, 265, then you will get to know A and B. When we take up SA 701, 705, 706, then you will get to know C. This point you need not specifically refer. You can ignore it. Clear? So like this list of auditors' responsibilities, simply what and all are your responsibilities. That responsibilities also you have to include in the auditor's responsibility paragraph. So then here comes the most important part. See, auditor's responsibility paragraph is not the important, but location of description of auditor's responsibility is very, very important. So where you can describe your auditor's responsibilities, what is the location of description of auditor's responsibilities? Very, very important here. So standard says that you can explain auditor's responsibilities. You can locate that auditor's responsibilities in three ways. Either you can include the auditor's responsibilities within the body of the auditor's report, or you can include the auditor's reporting responsibilities in an appendix to the auditor's report. In case if you are doing it as an appendix, you have to give a reference to the location of the appendix. Or what you can do is by a specific reference with the auditor's report to a location of such a description on a website of an appropriate authority where law, regulation or national auditing standard expressly permit the auditor to do so. Very important. I will take some time to explain it here. Sir, just now you have told us, just now we have gone through auditor's responsibility paragraph, no? There you have seen there are plenty of auditor's responsibilities. So many points are there, no? Sir, where I have to write all these auditor's responsibilities? Standard has given you three options. Option number one, include it within the body of the auditor's report. In the auditor's report only, under the heading auditor's responsibilities, there itself you include all your responsibilities. Like if you see here, Reliance auditors, what they have done. If you look at the auditor's responsibility paragraph, where is auditor's responsibility paragraph? Like if you see it here, the auditor's responsibility paragraph, they have included all the responsibilities within the body of the auditor's report. You can include it, all your, like whatever we have seen now, all that responsibilities they have included within the body. Now some auditors might feel that, sir, responsibilities are so many. If I include all that responsibilities in the auditor's report, it will look very, very lengthy, sir. Then what option standard has given you is do one thing. What you do is include it in the appendix. Include it in the appendix. Sir, what do you mean by that? What do you mean by including in the appendixes? So here what you can do is, instead of writing all these responsibilities in the body of the audit report, just to give this heading and say that refer appendix attachment. Appendix means attachment. So refer appendix A. So like that, just you can give the reference and all this descriptive information. You can attach one extra page. You can attach an extra page after the completion of the entire auditor's report. So either you can describe all your responsibilities within the body of the auditor's report. If you feel that report is looking very, very lengthy, what you can do is just give the heading, give the reference to the appendix and attach that appendix after the auditor's report so that user can go there and refer it. Or if there is a permission from law, regulation or standard, what one more option which the standard has given you is you can give a reference to the website. In case if all your responsibilities are mentioned in some website, let us say for example, if in the ICA website, what and all our auditor's responsibilities are given. So now what you can do is if it is permitted by law or regulation, instead of including within the body, instead of adding it as appendix, just give the website link. Visit so and so website, visit so and so link. In that link, you will be able to find all the auditor's responsibilities. You can give that link also. So very, very important point here. What is the location of description of auditor's responsibility? 3 options the standard has given. Either within the body you can do it, or you can do it as an appendix, or if there is a permission from law or regulation, even you can give the location of the website where the user can go and refer to that responsibilities. Clear? Able to understand everybody? So that is what regarding location of auditor's responsibilities, location of description of the auditor's responsibilities. Then apart from that, you will also have one more paragraph, other reporting responsibilities. So why this paragraph will be given is, see, till now whatever reporting requirements we have seen, those are all the reporting requirements as per standards on auditing, right? In addition to the standards on auditing, if the governing law of the client imposes some extra reporting requirements, like if you are conducting audit of a company, we will try to prepare the audit report as per standards. But under Companies Act 2013, the auditor might be required to report on some extra points, which we will see in this chapter. So we have some reporting requirements under 143 subsection 1, 143 subsection 3, 143 subsection 11. So we have some reporting requirements. Sir, where auditor will comment on those matters, sir, he can use this paragraph. So apart from standards, if there are any extra reporting requirements in any other laws and regulations, that all reporting requirements he can mention in this paragraph. So after putting all these things, you have to sign the auditor's report. You have to sign it. So if an individual auditor has been appointed, he will sign in his personal name. He will mention his name. In case if the firm is appointed as an auditor, not all partners are required to sign. One partner can sign on behalf of the firm. And while signing, that partner has to mention the firm's name, firm's registration number, his name, his membership number also he is required to mention. Like if you see the extract here, if a firm is appointed, this is how he has to sign it. So he has to mention the firm name, firm's registration number, which partner is signing, his name, his membership number also he is required to mention. So like this, audit report is required to be signed. And along with that, place of signature, the place where you are signing. When I say place you are signing, no need to include the door number, lane, address, all you are not required to do it. Just include the city wherever you are signing the auditor's report. Then after that, even you have to mention the date on which you are signing the auditor's report. The date of the auditor's report is also required to be included. And also, in addition to that, you are required to mention the UDIN also. So to avoid the forgeries, to avoid the misrepresentations by non-chartered accountants, every time today a chartered accountant is signing, he has to go to the UDIN portal and generate a unique number for every signature. That UDIN number is also required to be included, without which a signature is not at all going to be valid. So that UDIN number is also required to be generated. Without this UDIN number, the audit report is not going to be valid. Understood? So these are all the various contents of the auditor's report. Able to understand everybody? So this is what the most important content from SA 700. So what and all are the various contents of the auditor's report? So since we have done with the major content from the SA 700 part, so now what we will try to do is in SA 705, there are a few more important topics, not few more. There is, I think, one more important concept from SA 705 that if we could complete it, SA 500 and SA 705 also we would have successfully completed. Yes, so that is what this thing is about. Okay, so this point is once again, this point is one more point which is going to be important from SA 705. We will complete this. With that, we will wind up 700, 705. Then we will take up SA 701 talking about key audit matter and SA 706 talking about two contents, emphasis of matter and other matter paragraph. So before that, let us try to complete this. So this paragraph talks about consequences of an inability to obtain sufficient and appropriate audit evidence due to management imposed limitation. So as an auditor, you have accepted the engagement. You have accepted the engagement. But after you have accepted the engagement, when you are actually starting to perform, when you are performing the audit engagement, then because of imposition of limitation due to management, that means management is trying to put some restriction on you, because of which you are unable to obtain sufficient and appropriate audit evidence. Then what you will do, what will be the consequences? So what do they try to say here? You have accepted the engagement, you have started doing the audit, but during the course of the audit, management is trying to put some limitation. Management is trying to impose some restriction on you. They are trying to restrict you from doing your work, because of which you are unable to obtain sufficient and appropriate audit evidence. In those circumstances, what will be the consequences? And as an auditor, what will be your responsibilities? So here we have so much of paragraphical information, but all that information I have summarized it in the form of this chart. From this chart we will try to revise. So what auditor is supposed to do in case if auditor is unable to obtain sufficient and appropriate audit evidence due to imposition of limitation, due to restriction imposed by management? When after the auditor has accepted the engagement, then the management is coming and imposing the restriction, because of which you are unable to obtain sufficient and appropriate audit evidence. So in those cases, what you are supposed to do? Very simple, straight away step, be a gentleman, go and request the management to remove the limitation. So we will not take any absurd action. So first what we do, as I've told, behave like a gentleman, go to the management and say, sir, please remove the limitation. With this limitation, I'm unable to obtain sufficient and appropriate audit evidence. So first I will go and request the management to remove the limitation. Now, once you have went and requested the management to remove the limitation, two things can happen. What is it? Number one, management removes the limitation. Management told, okay, sir, we will not trouble you. We will we will not put any restriction on you. Do the work. Favorable scenario. So 99% of the cases, as I've told you, the clients will not try to mess with the auditors. So 99% of the circumstances, when we go to the management, we request the management to remove the limitation, and management removes the limitation. Management will no longer put the restriction. Then what we will do? Proceed with the audit procedures. Perform your audit procedures, try to obtain audit evidence, continue the audit, give your opinion, complete the audit. Because management has removed the limitation, no. So do your audit in an ordinary way. This doesn't require any separate discussion. Now, when the problem will come? So, as a gentleman, you went to the management and requested the management to remove the limitation, but management told, no, no, we will not remove the limitation. We will not let you do the work. We will put the restriction on you. So, you requested the management, but the management is refusing to remove the limitation. Then, what you should do? Then, Standard SA 705 says, first you are required to go and communicate with those charged with governance. If management is putting a restriction after your request also, if they are not ready to remove the limitation, what you should do? Go to the those charged with governance, top level management, whoever is there, go and communicate with them. Sir, your management is putting this restriction on me. Please request your management to remove it. So we'll go and communicate with those charged with governance. And also we will try to perform alternative audit procedure. Okay, management is putting a restriction. Is there any alternative procedure which I can perform without the management's help, without involving the management? Can I perform any alternative audit procedure to obtain the audit evidence? So whatever it is, think of the viable options. So if the management refuses to remove the limitation, first go and communicate with those charged with governance and perform the alternative audit procedures. Now, even after communicating with those charged with governance, or even after performing alternative audit procedures also, still you are unable to obtain sufficient and appropriate audit evidence, because management is putting very severe restrictions. Even after communication with those charged with governance also, no progress is happening. It tried to perform alternative audit procedures also. From that also, I am unable to obtain sufficient and appropriate audit evidence. So if you are still unable to obtain sufficient and appropriate audit evidence, then the standard says, determine what is a possible effect of that misstatement. Whatever procedures you are unable to perform, whatever areas management is putting a restriction, determine what is a possible effect. If those areas where the management is putting a restriction, if those areas goes wrong, what is a possible effect? See, if the possible effect is only material but not pervasive, management is not letting me to do some work, but because of that work which management is not letting do, there could be a possibility of a misstatement, and the possible effect, the probable effect of that misstatement is going to be material. It is significant enough to influence the decision of users, but it is not pervasive. Like we have already discussed what is the meaning of the term pervasive. So if the possible effect is material and material but not pervasive, you need not take any extreme action. What you can simply do is you can give a qualified opinion and end the audit. You can continue with the remaining areas. You can give a qualified opinion because of non-availability of audit evidence, where the possible effect being material and not pervasive. Give a qualified opinion, complete the audit. But in case if you have decided that the possible effect is going to be material and also pervasive, the possible effect is going to be material and also pervasive, here the standard has asked you to do extreme action. So if the possible effect has become material and also pervasive because of management imposed limitation, straightforward what you should do is you should try to withdraw from the engagement. Your first option should be wherever there is a possibility, withdraw from the engagement. Don't continue the engagement, withdraw from the engagement. In some cases, if a withdrawal is not permitted, in certain circumstances, withdrawal from the engagement might not be permitted by law or regulation. You might have to compulsorily continue the engagement. So, in those cases, if it is not possible to withdraw, then you continue the engagement and give a disclaimer of opinion. But first option, wherever possible, you should always try to withdraw. If a withdrawal is not permissible, if withdrawal is not possible on you, then you have to give a disclaimer. Okay. So you have to take extreme step when the possible effect being material and pervasive. So first option should be to withdraw. Wherever withdrawal is not permissible or not possible, then we will give a disclaimer. Understood. So this is what regarding consequences of inability to obtain sufficient and appropriate audit evidence. And one more small point I would like to say here. One more thing will be there. Yeah. See, we have seen previously what and all content will come in my auditor's responsibility paragraph. No, just if you remember, what and all content will the auditor include in the auditor's responsibility paragraph, right? So many points we have seen. There are many things which will come in the auditor's responsibility paragraph. But here SA 705 has told one thing. What SA 705 has told us, in case if you are giving a disclaimer of opinion, in case if you are giving which kind of opinion? Disclaimer of opinion. Then in your auditor's responsibility paragraph, you should not include all the points whatever we have discussed in the previous scenario. Your auditor's responsibility paragraph should be restricted, should contain only a few limited items, only a few points you are required to include. Which means what? So once again, if I show you here, see here, auditor has given, generally auditor will explain all these responsibilities. No, like we are required to obtain absolute assurance, we are required to maintain professional skepticism, we are required to identify necessary risk of material misstatement. So like that, generally auditor's responsibility paragraph will be very detailed, where we explain all our responsibilities. But SA 705 says, in case if you are giving a disclaimer, what you are doing, in case if you are giving a disclaimer of opinion, then in your auditor's responsibility paragraph, in this particular paragraph, all these detailed responsibilities you should not give. Why, sir? The logic is very simple. If you are giving disclaimer of opinion, means that you are unable to do the audit, right? So that's why you will not be able to fulfill these responsibilities. That's why the standard says, whenever you are giving a disclaimer of opinion, don't include all these responsibilities. We will tell you a few points that only you include in the auditor's responsibilities. Sir, what are they? So if you look at the terminology here, where the auditor disclaims an opinion on financial statements due to inability to obtain sufficient and appropriate audit evidence, the auditor shall amend the description of auditor's responsibilities. You have to update the auditor's responsibility paragraph to include only the following. That means in your auditor's responsibility paragraph, all that list of responsibilities should not come. In your auditor's responsibilities, only these 3 points should come. Only 3 points should come in my auditor's responsibility paragraph. So auditor's responsibility paragraph will be basically very, very limited in case if you are giving disclaimer of opinion. Sir, what will be included in my auditor's responsibility? Number 1, the auditor's responsibility is to conduct an audit. Your ultimate responsibility is to conduct the audit, that too in accordance with the standards on audit. But however, because of matters which have already explained in the basis for disclaimer of opinion, you are unable to obtain sufficient and appropriate audit evidence. Just to say that your responsibility is to express the opinion, but you are unable to do it because of some matters. Those matters you have already explained in the basis for disclaimer of opinion. And also state about auditor's independence and ethical responsibilities. Also mention that you are independent and you are also complying with ethical responsibilities. That's all. Your auditor's responsibility paragraph should contain only these 3 points. Apart from that, nothing else you are required to include, especially when you give a disclaimer of opinion. And one more last point I will try to clarify from SA 705. See, whenever you wanted to give modified opinion, either that could be qualified, that could be adverse, that could be disclaimer. Whenever you want to give any of this modified opinion, first you are required to communicate with the those charged with governance. No need to take the permission, just you have to communicate that. You have to go and tell them, sir, I'm supposed to give so and so opinion. This is wording, this is how the paragraph will look like. So first you have to communicate with the those charged with governance and then modify your opinion. Clear? So this is what the important content from 700 and 705. So we'll wind up these 2 standards now. Now we will take up SA 701. We'll try to revise SA 701, which is a key audit matter paragraph. So in your audit report, you are required to include a paragraph called key audit matter paragraph. So let us try to understand what is that key audit matter paragraph, what is the meaning, how you will communicate, when you will communicate, what is the purpose, everything we'll try to understand. Okay. So whatever it is, SA 701 says, in your auditor's report, you have to include a paragraph with the heading key audit matter paragraph. So first of all, we have to understand, sir, what is the meaning of that key audit matter? What is the meaning of key audit matter? So SA 701 says key audit matters are those matters which in the auditor's professional judgment are most significant while conducting audit of the financial statements of the current period. So when you are conducting audit of the financial statements of the current period, whatever matters that you have felt it as more significant while conducting the current year's audit, purely on the basis of your professional judgment. There is no hard and fast rule here. Purely on the basis of your professional judgment, you have to select a few matters which you feel it as most significant and explain to them as a key audit matter. And these matters should be selected from those matters which are communicated with those charged with governance. So if you want to if I have to put it in another way around, if you have to include something in the key audit matter paragraph, that you have to first communicate with the those charged with governance. Okay. So whatever it does, that is a meaning. Now you will get it out, sir. When we have so many other contents, like we have seen in our audit report, is not something which is very short. So much of information is there in the auditor's report. You said opinion, basis for opinion, management responsibility, auditor's responsibility. Sir, never ending. So many paragraphs we are already including in our auditor's report. Then what is the purpose of including this one more paragraph? Why you are including this one more paragraph called key audit matters? So that purpose, they say that the purpose of communicating key audit matters is to enhance communicative value of the auditor's report, to make the auditor's report more communicative. So to make the users get some more information from the auditor's report. So to increase that communicative value, to enhance that communicative value, this key audit matters has been provided, where greater transparency about the audit that was performed. And also it provides additional information to intended users to assist them in understanding those matters that in the auditor's professional judgment are most significant. And it will also assist the intended users in areas where significant management judgments are involved. So if you explain the key audit matters, that will help the users to even understand in a better manner those areas where the management has taken significant judgments. Okay, now, sir, you are telling key audit matters are those matters which in the auditor's professional judgment are more significant, no? Sir, who has to decide which matter is most significant, which matter is not significant? So the logic is very simple here. Auditor himself has to decide which matter is significant, which matter is not significant. That auditor himself has to decide. Sir, how he will decide it, sir? Purely on the basis of his professional judgment. That means auditor has to use his knowledge, experience and training, and using his professional judgment from the audit, he has to apply his mind and select key audit matters. There is no hard and fast rule anywhere which says this is always a key audit matter like that. It's nothing like that. So that is completely your professional judgment. But it will be wrong for the standard to leave completely everything on the auditor, right? At least the standard should guide them what factors he has to consider when deciding whether a matter is a key audit matter or not. So there could be plenty of issues which auditor might have come across, right? So out of all that matters, which matter is a key audit matter or not, how the auditor will decide, sir? Agreed, professional judgment, but the standard should at least help them, right? They should at least tell them what factors he will consider. Or if I put it in other way around, in what kind of areas he has to go and search for key audit matter, that standard should have explained. No. So the standard has given that guidance. So standard has told that these are the matters which you are required to consider significant attention. That means if you want to select the key audit matters, you can start taking the following factors into mind. Or if I put it in other way around, you can start looking for key audit matters in these three kind of areas. Sir, which kind of areas? In those areas where there is a high risk of material misstatement. So generally in the items of the financial statements, there will be multiple areas. Okay. Not every area will have a equal risk of material misstatement. Some areas will have high risk of material misstatement. So you can select those areas as key audit matters where there is a risk of high material misstatement. Or you can select the key audit matters from those areas where significant judgments are involved. Those areas where so many judgments are involved, like depreciation, provision for bad and doubtful debts. These are the areas where judgments will be involved, right? So you can select the key audit matters from those areas where significant auditors' judgments relating to financial statements are involved. And not just that, the effect of audit on significant events or transactions. Even you can select the key audit matters from any significant event or transaction which have taken place during the current year. Like any acquisition has taken place, any merger has taken place, any amalgamation has taken place. So you can also select key audit matters from those areas. Okay, right. So like this, these are the areas where you are required to go and communicate the way where you can go and search for key audit matters. Now, one small doubt here. Sir, is key audit matter paragraph required to be included in the audit report? Is it applicable for each and every company, each and every entity? The answer is no, my dear students. For the time being now, key audit matter paragraph has not been made mandatory for each and every company. So today, only a handful of companies auditors are required to include the key audit matter paragraph in their auditor's report. Sir, where the communication of key audit matters is mandatory. So here you will be able to find it. So if you see here, whenever you are conducting audit of general purpose financial statements of listed entities, which entities? Listed entities. So if you are conducting audit of general purpose financial statements of listed entities, then you are required to communicate the key audit matters in the auditor's report. Then it is mandatory. If you are conducting audit of a listed company, mandatory. Sometimes your client might not be a listed company, but some law or regulation may ask the auditor to communicate key audit matters. Then also you have to do it. So listed company, mandatory. Sometimes even though it is not a listed company, some law or regulation may make it mandatory to communicate the key audit matter. Then also you have to communicate. Next. So here also you are able to find it here. Law or regulation may require communication of key audit matter. In other cases, the auditor may also decide to communicate key audit matter for other entities. For rest of the organizations, it is completely up to auditor's choice. So three things here, the summary of this entire paragraph. If you are conducting audit of a listed company, compulsory. If there is a requirement of law or regulation, then also it is compulsory. In other entities, let the auditor himself will decide. So if the auditor feels that there is one very big company, not public company, not a listed company, not even required by law or regulation, but if he feels that here stakeholders are very much interested to know about key audit matters, or if the auditor felt that if I communicate key audit matters in this organization, the users will get benefited, then he can communicate it. But in two cases, it is mandatory, listed, and when there is a legal or regulatory requirement. And few more things here. If you come back to once again, I say 705. 701. Right. Okay. So we have seen what is the meaning of the key audit matter, what is the purpose of communicating the key audit matter, from which areas you have to determine the key audit matters, and also where it will become applicable. Now, communicating key audit matters is not a substitute for certain things. Very, very important point here. This point. Communicating key audit matters is not a substitute for certain things. So they say that communicating key audit matters is not a substitute for three things. Listen carefully. If you are communicating key audit matters, that communication of key audit matters is not a substitute. That means it is not an alternative for three things. What are the three things for which it is not a substitute for? Number one, communicating key audit matters is not a substitute for giving a disclosure in the financial statements by the management as per the applicable financial reporting framework. Communicating key audit matters is not a substitute for giving a modified opinion. And also, communicating key audit matters is not a substitute for material uncertainty relating to going concern paragraph required as per SA 570. Okay. So three things here, my dear students. Communicating key audit matters is not a substitute. That means it is not an alternative for three things. What are they? Number one, it is not a substitute for disclosure in the financial statements, which is required to be given by the management as per applicable financial reporting framework. It is not a substitute for giving a modified opinion. It is also not a substitute for going concern paragraph required as per SA 570. So if I try to give the context, what exactly this means is, let us say, for example, management, some company X Limited is there. You are conducting audit of that entity. Who is required to prepare financial statements? Management. Who is required to give all the disclosures in the financial statements? That means who is required to give explanations in the notes to accounts? Once again, management. Now, management of this company prepared the financial statements. After preparing the financial statements, they have realized that in the notes to accounts, they have not added one disclosure. They forgot to give one explanation. Can they now come and request the auditor, sir, we forgot to give some disclosure in the financial statements in the notes to accounts. You do one thing, anyhow you will give key audit matter paragraph in your auditor's report, no? Whatever disclosure that we have forgot, that you include it in the key audit matter paragraph. Can the auditor say yes to this? Do you think is this the purpose of the key audit matter? Do you think key audit matter paragraph has been introduced so that if the management forgets something, they can come and request the auditor to include it? No, my dear students. If some disclosure is required to be given by the management in the financial statements, that has to be given by the management only. Key audit matter is not a substitute for that. Auditor should not accept to it. Similarly, let us say, for example, you are conducting an audit of financial statements. You find a material misstatement. You found a material misstatement. When you found a material misstatement, what should be your course of action? So we all know that when I found a material misstatement, my course of action should be to give a modified opinion. Yes or no? Can the auditor say, instead of giving a modified opinion, I will highlight it, I will communicate in my key audit matter paragraph? Can he say that? Do you think his key audit matter paragraph has been given as a substitute for giving a modified opinion? Instead of giving modified opinion, you explain it in the key audit matter paragraph. Do you think is that the purpose? No. And also, key audit matter paragraph is not a substitute for material uncertainty relating to going concern. So in the financial statements, in In the auditor's report, there is one paragraph called material uncertainty relating to going concern, which we will discuss in the SA 570. Whatever information that has to go to material uncertainty paragraph, that should go to material uncertainty paragraph only. The auditor cannot say whatever information that I am required to include in my material uncertainty paragraph, that I will include it in the key audit matter paragraph. You can't say it. So whatever information should go to material uncertainty paragraph, there only it should go. Whatever paragraph, whatever information that should come to key audit matter paragraph, here only it has to come. It is not a substitute. So like this, key audit matter is not a substitute for these three things. And also they say one more thing. When the auditor is explaining the key audit matter, he is not giving any separate opinion on any of the matter. He is not giving any separate opinion on any of the matters. Just he is letting you know what and all procedures he has performed, how he has tackled the difficult areas. That itself they are saying here, they are not giving any separate opinion on any of the matters, right? So it's not giving any separate opinion on any of the matter. Now coming forward, so this we have, this paragraph we have completed. Communicating key audit matter is not a substitute. Next, here also, whatever matters you want to communicate it to the communicate in the key audit matter paragraph, those matters are required to be communicated with those charged with governance. So whatever matters that you have determined to be key audit matter. And one more point here, in case if you have conducted the audit but you are unable to identify any key audit matter, then even you have to mention the fact that there are no key audit matters. So this is one important point here. Let us say, for example, you are conducting audit of listed entity. Now you have completed the audit, you are preparing audit report, you are required to include key audit matter paragraph. But you have started making analysis. See, after doing all the audit also, still I am unable to find out anything which is very significant. Then what you should do, then you have to include the key audit matter paragraph. In that paragraph, you have to say there are no key audit matters. In that paragraph, you have to specifically say there are no key audit matters. Clear, everyone? And one more thing here, one more point I would like to add here. With that, we will end SA 701. In case if you are giving a disclaimer of opinion, which opinion? In case if you are giving a disclaimer of opinion, then your audit report should not contain key audit matter paragraph. Very specifically they have told it here. In case if you are giving a disclaimer of opinion, even though you are conducting audit of listed entity, but still in that listed entity, if you are giving a disclaimer of opinion, our audit report should not contain key audit matter paragraph. You should not include that paragraph at all. So this is one more change we have to do to our audit report. In case if you are giving a disclaimer of opinion, it should not contain any key audit matter paragraph. So with this, we have successfully completed SA 701 also. Right. So since you have completed SA 701, now we will try to do SA 706. Very simple standard, very small standard, which we will talk about two contents in the auditor's report. Number one is emphasis of matter paragraph, and the other one is other matter paragraph. So SA 706 is a standard which is going to talk about two contents. Number one, emphasis of matter. Number two, other matter paragraph. So let us try to understand what is this emphasis of matter paragraph, what is this other matter paragraph. So first I will try to talk about emphasis of matter paragraph. Sir, what is this emphasis of matter paragraph? The term emphasize, emphasis, which means to highlight. What is the meaning of the term? The general meaning of the term emphasis, emphasize means what? To highlight. So the name itself says you are highlighting something in your auditor's report. So if I tell you the meaning, if I tell you the definition, when we will use the emphasis of matter paragraph, they say that who will prepare financial statements? Management, right? So management has prepared financial statements. Management has prepared the financial statements. In the financial statements prepared by the management has already presented and disclosed, and information has been adequately presented and disclosed in the financial statements. In the financial statements which management has prepared, the management has not committed any mistake. There is some matter for which they have given adequate presentation and disclosure. Let us say, for example, there is a contingent liability. This company is going through court case and they have explained about that contingent liability in their note number 27. So the management in the financial statements, whatever they have prepared, without their mistake, they have adequately presented and disclosed an item. There is no mistake on the management part. But as an auditor, I felt that even though the management has already presented or disclosed that item in the financial statements, but since each and every user may not go through the entire financial statements, some users might miss out on this important information which is regarding contingent liability. So I felt that this matter which is already presented or disclosed in the financial statements, it is very fundamental to users' understanding of the financial statements. It is very much fundamental to the users of the users of the financial statements. So I felt that there is a need to highlight this information to the users. Sir, how can I highlight, sir? Can I highlight it by giving modified opinion? No, you can't do it. Sir, then how can I highlight? The standard told, do one thing. In your audit report, use a paragraph, emphasis of matter paragraph. Like this, use one paragraph. And whatever matter you want to highlight, that you can highlight it in this matter. So you can say that I can write it here in this typical scenario. I want to make sure that each and every user goes through that contingent liability. There is no fault on the management. Management did not do anything wrong. They did not hide anything from the shareholders. Clearly, they have adequately presented and disclosed about that contingent liability in their financial statements. There is no fault on the part of the management. But this matter is very, very fundamental to users' understanding. I want to highlight it somewhere in my auditor's report. What you can do? Use an emphasis of matter paragraph. Now here what I can say is, I can say that please refer to note number so and so. Please refer to note number 27, where the management has disclosed, where the management has given something regarding contingent liability. You must refer, the company is going through the client case regarding which they have got a contingent liability. To get more details, please refer that note number 27, that I can highlight it in the emphasis of matter. So that if I include this emphasis of matter paragraph, every reader who reads my audit report, definitely he will go to note number 27 and he will get to know about that contingent liability. That is what the purpose of emphasis of matter paragraph. So you tell me guys, by including the emphasis of matter paragraph, am I giving any negative comment? By giving an emphasis of matter paragraph, am I giving any negative comment? No, my dear students, I'm not giving any negative comment. I'm just saying that management has disclosed some information. Please go and refer that information. That's what I'm saying. Just by highlighting that, I'm not saying something is wrong in that note number 27. No, I don't say it. Just I'm saying management has disclosed some important information in the financial statements. Dear reader, please go and refer to that. That is what emphasis of matter paragraph is used for. So like if you see here, yeah, I will come directly to the definitions here. Emphasis of matter paragraph is a paragraph which is included in the auditor's report that refers to a matter which is appropriately presented or disclosed in the financial statements. So some matter is appropriately presented, disclosed in the financial statements, but in the auditor's judgment is of such importance that it is very much fundamental to users' understanding of the financial statements. So even though it is already presented or disclosed in the financial statements, auditor felt the need that it is very fundamental to users' understanding. You wanted to highlight it somewhere. There you can use emphasis of matter paragraph. Now, few things they say about emphasis of matter paragraph. So emphasis of matter paragraph in the auditor's report. Sir, why we use it? Once again, same point. If you want to draw users' attention to a matter which is already presented or disclosed in the financial statements, and it is very fundamental to users' understanding of the financial statements, then you are required to include an emphasis. But you can include emphasis of matter paragraph in the auditor's report, provided the auditor would not be required to modify the opinion as a result of the matter. So whatever matter you want to highlight, let us say for example, I told contingent liability, no? So this contingent liability, I can highlight it as an emphasis of matter paragraph only if it is not materially misstated. See, if the management has disclosed note number 27, but in that note number 27, they're talking about contingent liability. They told something wrong regarding contingent liability. That means there is a material misstatement in the contingent liability. So if there is a material misstatement in the contingent liability, I have to give modified opinion. No. So that matter, I can't highlight it in the emphasis. If a matter is there in the financial statements because of which I'm required to give modified opinion, that matter you can't highlight it in the emphasis of matter paragraph. For that, you have to say it in the modified opinion. Clear? Able to understand? So you can highlight only those matters in the emphasis of matter paragraph regarding which you are not required to issue any modified opinion. That means those matters which are not materially misstated, which are adequately presented and disclosed, only that you can highlight it as emphasis of matter paragraph. And also, when SA 701 applies, matter has not been determined to be key audit matter. That means if a matter has already been communicated as a key audit matter, you should not include it once again in the emphasis of matter paragraph. Clear everyone? So two things they say here. You can highlight any matter which is fundamental to users' understanding and which is already presented or disclosed in the financial statements as an emphasis, provided because of that matter you are not required to give modified opinion and that matter has not already been determined as a key audit matter. If these two conditions are fulfilled, that matter you can highlight it in the emphasis. Next one. So whenever you want to include an emphasis of matter paragraph, add a separate section. Definitely right, 100% we will do it. We will not mix it with other paragraphs. Use a dedicated paragraph with the heading emphasis of matter, and there you have to talk about that emphasis. So when the auditor includes an emphasis of matter paragraph, the auditor shall include the paragraph within a separate section of the auditor's report with a separate side heading, emphasis of matter. Don't club it with other paragraphs. Give a separate heading. Include in the paragraph a clear reference to the matter being emphasized. You have to give a clear reference. Like I told you in our example, refer to note number 27, refer to note number 54, refer to note number 38. So like that, you have to give a clear reference to the matter being emphasized. And also you have to specifically say that your opinion is not modified because of that matter. I told you, no, just because I am giving that in the emphasis of matter paragraph, am I giving any negative comment? No. But generally people will have some wrong notion. When they say auditor is saying something, they will have a wrong conception that there is something wrong in that item. So to sort out that, add one line at the end of this paragraph. Our opinion is not modified. We are just highlighting this information and our opinion is not modified. So just add that caution so that user will not make wrong decision. Next one. Sir, what are the examples of the circumstances where auditor can include an emphasis? Generally, they are giving you a few examples. What kind of circumstances will be highlighted in the emphasis of matter? A few examples only, not conclusive list, just an illustrative list. So some of the examples of the circumstances which are necessary to be included in an emphasis. What are they? Number one, an uncertainty relating to future outcome of an expected exceptional litigation or regulatory action. Nothing but contingent liability. Guys, examples are very important. Multiple times I've asked a question. So if you have any contingent liability like litigations you are going through that management has already disclosed in the financial statements, you want to highlight it somewhere in the auditor's report, that you can do it in the emphasis. Or subsequent event that occurs between the date of financial statements and date of auditor's report. If any subsequent event is there which has been adjusted in the financial statements that you want to highlight it in the emphasis. Early application of a new accounting standard. Your client has made a new early application of a new accounting standard, that also you can highlight it in the emphasis. Or even a major catastrophe like fire accident, calamity, loss. So if any exceptional events are there, if any major catastrophe that has a significant effect on the financial position, management did not hide it. They have explained in the financial statements, that you can highlight it in the emphasis. So once again, I am saying this is only illustrative list. This is not the conclusive list. Next. Emphasis of matter paragraph is not a substitute. Just if you remember, just now as I have told in SA 701, if you are communicating key audit matter is not a substitute for three things, right? Even for the same three things, emphasis of matter is also not a substitute. Like emphasis of matter paragraph is not a substitute for disclosure in the financial statements. It is not a substitute for giving a modified opinion. It is not a substitute for material uncertainty relating to going concern paragraph required as per SA 570. So I'm not repeating once again whatever we have covered in SA 701. There are three things for which key audit matter is not a substitute for, yes or no. For the same three things, even emphasis of matter paragraph is also not a substitute. Clear everyone? So the same paragraph they try to say it here. So this is what regarding emphasis of matter paragraph. So we are done with one part of the standard. But I told that this standard is going to talk about two paragraphs. One is emphasis of matter and the other one is what? Other matter paragraph. See, very simply they try to put it here. See, if emphasis of matter paragraph is used to highlight information which is already presented or disclosed in the financial statements. Now they say that other matter paragraph is a paragraph which is used to highlight that information which is not presented or disclosed in the financial statements. That's it. In one single line, they will end the entire discussion. So like if you read it, other matter paragraph is a paragraph which is included in the auditor's report that refer to a matter other than those presented or disclosed in the financial statements, and which is in the auditor's judgment is important for users' understanding of audit, auditor's responsibility, or auditor's report. So some information, even though not presented or disclosed in the financial statements, you feel that is important for users' understanding of the audit, auditor's responsibility, and auditor's report, that you can include it in your other matter paragraph. Whatever not presented or disclosed in the financial statements. If I have to put it in very simple terms, why we mainly use other matter paragraph is to talk about the responsibilities of the auditor. In practical circumstances, why we mainly use other matter paragraph is to talk about auditor's responsibilities. Like for example, if last year audit was not done by you, if corresponding figures are not audited by you, you want to tell that, you can say it in the other matter paragraph. Or you want to say that one of the branches is not audited by you. You want to say that I did not do audit of one of the branches. For one of the branches, separate auditor is there. For that, you can use other matter paragraph. Or if there are any unaudited branches, so and so unaudited branch is there, that you can include it in your other matter paragraph. So mainly, auditor will use other matter paragraph to explain about his responsibility related matters, any additional responsibility taken or any reduction in the responsibilities. So that's what they say here, other matter paragraph in the auditor's report. Sorry, my dear students. So if the auditor considers it necessary to communicate a matter other than those that are presented or disclosed in the financial statements, which is relevant to users' understanding of audit, auditor's responsibilities, or auditor's report, that you can include it in the other matter paragraph. And you can include that matter in the other matter paragraph when it is not prohibited by law or regulation, and also when the matter is not a key audit matter. Why? Because if the matter is already a key audit matter, that we will explain it in the key audit matter only. Why we will bring it once again to the other matter paragraph? So you can explain about something in the other matter paragraph when it is not prohibited by law or regulation and the matter is not determined to be a key audit matter. Like the way we are including the emphasis of matter paragraph in a separate paragraph, even other matter paragraph, for that also we have to dedicate a separate paragraph for that. And one more last important thing, if you want to communicate other matter paragraph or emphasis of matter paragraph, first you have to go and communicate with those charged with governance. Like the way if you want to include key audit matter, we are going and communicating with those charged with governance. No, in the same manner, if you want to include emphasis of matter paragraph or other matter paragraph, first you have to go and communicate with those charged with governance. But once again, you have to be pretty careful here. They are not asking you to get the permission, they are only asking you to communicate. That's all. Just go and communicate, no need to get any permission. Clear and comfortable, everybody? So this is what regarding 4 standards. Understood? Comfortable, everybody? Right. We are going to now talk about, till now we have seen the reporting requirements under the standards on audit. So now we will see some reporting requirements under 143, section 143 of the Companies Act. So under 4 sections we have reporting requirements: subsection 1, subsection 3, subsection 11 and subsection 12. So first we will try to cover reporting requirements under 143 subsection 1. Here we have 6 matters on which we are required to report. Very many times they have tested it, and this they will test also. This is having a scope for testing. So the 6 points which are required to be commented by the auditor, reported by the auditor under 143 subsection 1 are as follows. Come on, let us repeat along with me. First point, you are required to comment whether loans and advances which are made by the company. So first point is regarding loans and advances, and they're telling made by the company. When I say made by the company, given by the company or received by the company? Loans and advances which are given by the company to the others. If they are telling it on the basis of security, if they have told that they have given the loans and advances on the basis of the security, whether they have been properly secured. What do you mean by properly secured? When we can say a loan is properly secured? The amount of asset, the value of the asset which has been offered as a security, that value should be more than the amount of the loan given. Then we call it as properly secured. So whether loans and advances which are made by the company to others, if they are given on the basis of security, then we should check whether they are properly secured or not. And even we should check the terms and conditions on which those loans have been made. Are they prejudicial? Prejudicial means what? Harmful to the interest of the company or shareholders. That is the first point. Number 2, we need to check whether the transactions which are represented merely by book entries are prejudicial. What do you mean by transactions represented merely by book entries? So not fake entries actually. Sometimes there could be genuine entries also which are represented merely by book entries, like depreciation, provision for bad and doubtful debts. These are just merely book entries. So we need to check these kind of transactions which are represented merely by book entries, are they prejudicial? That means whether over provision, under provision has been created, that we need to check it. Third one, where the company not being an investment or banking company, whether so much of the assets of the company as consists of shares and debentures and other securities have been sold at a price less than purchase price. Basically, if your client company is other than investing company or banking company, if it is investing company or banking company, this point does not become applicable. Your client is a normal company which is other than investment company or banking company. In case if they are holding investments in the form of shares, debentures or bonds, have they sold it at a loss less than purchase price? Once again I am telling you, sometimes they will try to confuse you giving the market price. They will say the purchase price of the shares is 100, the current market price is 120, whereas the company sold the shares at, okay, no, not like this. So let me give it to you. Purchase price is 100, current market price is 90, but the company was able to sell it at 95. The company is not an investment company or banking company. Is this transaction required to be reported or not? Yes. What is current market price? Irrelevant. Just we need to compare two values: sale price minus purchase price. So if the sale price is less than the purchase price, you have to report it here. Understood? Next, fourth one, whether loans and advances made by the company have been shown as deposits. So fourth point is also talking about loans and advances which are given by the company. If your client company has given loan and advance, but instead of showing it as loans or advance, is it showing it as deposits?
that you have to report it here. And whether personal expenses have been charged to revenue account. What do you mean by that? Whether personal expenses have been shown as business expenses. So whose personal expenses? Company will not have any personal expenses. Company will not go on vacation. Company will not enjoy anything. So whether the personal expenses of directors, employees, have they been treated as business expenses? That we need to check. And also, in case if your company has allotted the shares for cash, whether that cash has actually been received, and if not, the position stated in the financial statements should be correct and not misleading. So these are the 6 points which are required to be reported under 143 subsection 1. What are they? Loans and advances made by the company are properly secured and terms are not prejudicial. Number 2, transactions represented by mere book entries, they should not be prejudicial. Number 3, other than investment company, banking company, have they sold their investments at less than purchase price. Number 4, loans and advances have been shown as deposits. Number 5, personal expenses have been charged to revenue. Number 6, if your client company has allocated shares for cash, whether cash has actually been received. If not, position should be correct and not misleading. And these 6 points are required to be reported only when you have a negative comment. Only when you have a negative comment, then only these 6 points are required to be reported. If you have positive comment, you are not required to report. If you are unable to find any of this point in the audit report, what does that mean? That means that auditor has verified all the 6 points, but he did not find any negative comment regarding any of the 6 points. Understood? Clear? Then coming to 143 subsection 3, we have some 143 subsection 2 simply says you are required to give a report. So whatever accounts you have examined, on that you have to give a report. In that report you have to say financial statements give a true and fair view or not. This you can ignore it. So now let us come to 143 subsection 3. In 143 subsection 3, we have various reporting requirements. Starting from clause A till clause I, we have various reporting requirements. There is a very less chance of asking the question. Write all the reporting requirements under 143 subsection 3. They will not ask. Why? Because today question will be tested for maximum 4 marks or 5 marks. So for that, they will not ask you this much lengthy question. But what is the probability is they might ask only this point. What are the reporting requirements? Sorry, not this one, this one. What are the reporting requirements under 143 subsection 3 clause J? So under 143 subsection 3 clause J, we have 6 matters which are required to be reported. Out of that, the first 3 matters are old. They are there for a very long period of time. But D, E and F were added in the recent times. So that's why this particular point is gaining more significance in the recent times. So what are that matters which are required to be reported under 143 subsection 3 clause J? First one, whether the company has disclosed the impact, if any, of pending litigations. So as an auditor, you are required to comment whether company has disclosed the impact of pending litigations. Are they asking the auditor to disclose the impact of pending litigations? Are they asking the auditor to disclose the impact of pending litigations in his audit report? No. They are asking the auditor to check whether management disclosed the impact of pending litigations in financial statements. They are not asking auditor to give disclosure of pending cases. They are asking auditor to check whether management has given disclosures regarding pending litigations in the financial statements. Number 2, whether the company has made provision for material foreseeable losses. If the company came to know now itself they are going to make a loss on a contract, that contract is going to take place over a span of 5 years. Can they wait for 5 years for recognizing the loss? No, they should have recognized in year 1 itself. So like that, if the company is going to have material foreseeable losses on long-term contracts, whether they have created a provision or not, that also I need to check and give a comment. Third one, whether there has been any delay in transferring the amounts which are required to be transferred to Investor Education Protection Fund. As we all are aware, some amounts are there which are required to be transferred to IEPF. So we need to check whether your client is having any such amounts which are required to be transferred to IEPF. Each amount will have a deadline also, whether amount has been transferred within the deadline or has there been made any delay in transferring the amount to the IEPF. So that we need to check and give a comment. Now comes the D point. So let us try to understand. In the D point also 3 sub points are there. We will try to understand this with the help of example. Okay. Fine. So 3 things here. If you read the text, it becomes quite complicated. Let us try to understand. See, you are conducting an audit of the client X Limited, which is a client company. You need to ask the management of your client company. Whom? You should ask the management of your client company to give a representation, to give a written confirmation that they did not involve in certain transactions. They did not involve in certain transactions. Which are transactions? They should not have given funds in the form of loan or in the form of advance to some another entity. Say for example, we call them as Y Limited. For the time being, we call them as intermediary. So your client has given any loan or advance to some entity which we call them as, which that entity to whom the loan or advance or any amount has been given, investment has been made, that entity we call them as intermediary. But there is an understanding between whom and whom? Between the client company and the intermediary, there is an understanding. That understanding could be in written format or otherwise. That could be a written understanding, that could be a oral understanding also. And what is that understanding is, this intermediary should go and give that either amount as a loan, advance or investment, or give a guarantee on behalf of some further entity. Say for example Z Limited, which we call it as ultimate beneficiary, which we call it as ultimate beneficiary. So if you, whether your client has engaged, they should do these transactions or they should not do these transactions. See, generally, if you look at the entire scenario, what is happening is X Limited, your client company, wants to do some favor to Z Limited, which is an ultimate beneficiary. Either they are prevented from doing it, or if they have done it directly, they might be answerable to many people. They might have to face so many questions. So in order to avoid that questions, what your client company is doing is, instead of transferring the favor, instead of doing the favor directly to ultimate beneficiary, they have created one intermediary. So they are giving loan, advance or investment to Y Limited with the understanding that Y Limited should go and give loan, advance or give a guarantee on behalf of ultimate beneficiary. So what in the back end happening is, X Limited wants to do some favor to Z Limited, but instead of doing it directly, they have created one intermediary. Is it misleading or not? Should they do it or should they not do it? They should not do it. So you should ask your client's management to give a written representation that they did not do these kind of transactions. They have not given any loan or advance to another entity with an understanding where that intermediary should go and further give a loan or advance or give a guarantee on behalf of ultimate beneficiary. They did not indulge in these transactions. Ask the management of your client company to give a written confirmation. That is the first point there. Second point, if you come to the second point, what they say here is, say for example, you are conducting audit of the client X Limited. Once again, this is your client company. Now, here also from your client company, you should ask some confirmation that they did not do certain transaction. Which kind of transaction? That your client company has received some loan or advance from another entity. Say for example, A Limited, which we generally call it as funding party. Which we call it as what? Funding party. Here your client has received. So from funding party, and between the funding party and your client company, there is an understanding. That understanding could be in writing or it could be in otherwise. What is that understanding is, whatever money that your client has received, they have to either go and give it as a loan or advance or give a guarantee on behalf of some another entity B Limited, which we here call it as ultimate beneficiary. You tell me, should your client indulge in these kind of transactions? Here what is happening? Some entity wants to do favor to another entity. In our example, funding party wants to do some favor to ultimate beneficiary. But to facilitate the transaction, your client is acting as a mediator. Should they do it or should they not do it? So ask the same from the management that they did not indulge in these kind of transactions. So first point, they should not have created any intermediary. I'm not visible, no? You did not tell me only here. Half of the face is not visible. Right. Yeah. So in the first point, they have told that you should not be creating any intermediary by which you are doing a favor to ultimate beneficiary. Second case, you should not act as a intermediary. So you should not indulge in these kind of transactions. Ask the management to give a confirmation that they have really not done it. So if you go and ask the management, they will give you confirmation, but will you blindly believe it? No. So now what the third point says is, first you go and ask the management to give that written representation. Okay, management will give it. Now what you should do is, you should perform some audit procedures, whatever you find it as reasonable and appropriate, and you should comment nothing has come to your notice that has caused them to believe that representations under clause 1 and clause 2 contain any material misstatement. So if you go and ask the management to give confirmation, they will give confirmation, but you perform some procedures, whatever you feel it as appropriate, and determine whether there is any thing which is coming to your notice which makes you doubt that representation. Understood? So that is what reporting requirements under clause D of 143 subsection 3 clause J. Then two more extra points are there. In case if your client company has declared the dividend, you are required to check whether that dividend has been declared in accordance with the provisions of section 123 of the Companies Act. They can't declare whatever dividend they want. There are certain rules, certain calculations which you are required to follow, so that you need to check. And also one more latest update, your client should be using accounting software. Starting from the 1st of April 2024, they should be using an accounting software which is having a feature of recording of audit trail. So what is basically audit trail? Edit log also you can say that thing, but the background of the transaction. So flow of the transaction, who initiated, who updated, who deleted, that background things also should be there. So that we call it as audit trail. And from 1st April 2024, every company should use only such accounting software which have a feature of recording audit trail. So that they made it mandatory on the companies. Now they put a responsibility on the auditor to check whether really companies have complied with that requirement or not. Understood? So these are the extra reporting requirements under 143 subsection 3 clause J. This also they have asked it and they have a chance of testing it now also. Understood? So we have completed 143 subsection 3, 143 subsection 1. Now we will talk about reporting requirements under 143 subsection 12, which is relating to reporting of fraud. So as an auditor, during the course of your audit, if you come across any fraud, you are required to report it. And how to fulfill that reporting requirements, let us try to have a look at that. So in order to fulfill the reporting requirements, or your reporting requirements is going to depend on what is the amount involved in the fraud. What is the amount involved in the fraud? If the amount involved in the fraud is what? How much? If the amount involved in the fraud is 1 crore or more, then central government reporting will become applicable. If the amount involved in the fraud is less than 1 crore, then central government reporting will not become applicable. So if you are conducting the audit, during the course of the audit, if you come across any fraud and if you have reason to believe that amount involved in the fraud is 1 crore or more, you are required to report that to the central government. How to report to that central government? What is the manner of reporting? First thing, the moment you came to know about fraud, within 2 days, you are required to report this matter. To whom? So audit committee or board of directors, they say, but here there is one thing which students often get wrong. It is not a choice. It is not a choice. The Act 140 subsection 12 did not give a choice for the auditor to decide to whom to send. If audit committee is there in the client company, you have to report it to audit committee only. If audit committee is not there, then you have to report it to board of directors. So it is not your choice. If audit committee is there, you can't decide, okay, instead of sending audit committee, we'll send it to board of directors. You can't say that. If audit committee is there, only audit committee. If audit committee is not there, then to the board of directors. Within how many days? Within 2 days of knowledge of the fraud. So once you have communicated with them, you should give them 45 days of time. How much time? 45 days of time. For what purpose? To reply. So you have communicated the matter to the management. So you expect some reply from them. So you wait for 45 days for their reply. So within 45 days, two things might have taken place. What two things might have taken place? So you might have received a reply. In case if you have received a reply, within 15 days of receiving the reply, within how many days? Within 15 days of receiving the reply, you have to report that matter to central government. So what and all you have to report to the central government? The report which you originally sent to board of directors or audit committee, what reply you have received, on that reply what are your remarks? Three things: report which you have sent to audit committee or board of directors, what reply you have received, on that reply what is your remark. These three things are required to be communicated to central government. And how you have to communicate? In form number ADT 4. In which form? Form number ADT 4. And this information should be sent on letterhead. It should contain your address, your name of the firm, your membership number, your seal also should be there, your stamp also should be there. And when I say you have to report to the central government, to whom you will report exactly in the central government? Prime Minister of India? No. So when I say Secretary, Ministry of Corporate Affairs, what do you mean by central government here? To the Secretary, Ministry of Corporate Affairs. So if you receive reply, within 15 days of receiving the reply, you are required to communicate this matter to central government. So by submitting a form ADT 4, within how many days? Within 15 days. Sir, what if within 45 days, if I don't get any reply? I intimated the matter to the I intimated the matter to audit committee or board of directors. I gave them 45 days of time, but I did not get any reply from them. Then what I should do? Then what you should do is, in those cases, also you are required to report to the central government. So, but what you will report there? whatever report you have sent to audit committee or board of directors, along with one fact that you have not received any reply. That information you will send it to central government. But here the act is silent on time limit. They did not mention time limit, but however we can derive the time limit from other scenario. So what is the time limit in other scenario? You are going to get a maximum of 15 days of time from what? From the date of, from the expiry of 45 days. Either you can say that way, or you can say within a time of maximum 60 days from the date of communication with audit committee or board of directors. So within that time limit you are required to send a report to the central government. Okay. Okay. So if the amount involved in the fraud is 1 CR or more, so this is what you are supposed to do. So what if the amount involved in the fraud is less than 1 crore? Then you are not required to report to central government. But can you ignore that fraud? No. So what you are supposed to do is, in case if you came to know about the fraud where the amount involved is less than 1 crore, you are required to report this matter to audit committee or board of directors. Same, the logic whatever we have applied there, the same logic. If audit committee is there, to the audit committee. If audit committee is not there, then to the board of directors within 2 days. What and all you have to communicate? A brief description of the fraud along with approximate amount involved and who are the parties involved. So 3 things: nature of the fraud along with the description, who are the parties involved, and what is the approximate amount involved. With that your responsibility will come to an end. But after this, the management will have one more responsibility. They will give something called board's report. What they will give? They will give something called board's report. So in that board's report, management is required to give disclosure, not auditor. Who? Management is required to give disclosure. What disclosure they are required to give? The same 3 things along with what remedial actions were taken. The same about 3 things along with what remedial actions were taken. So that 4 information they are required to disclose it where? In the board's report. Understood? So these are the reporting requirements under 143 subsection 12. Now let us come to the most important part, the reporting requirements under 143 subsection 11. So there is other name for the reporting requirements which we also call it as CARO 2020. How many matters are there? There are a total of 21 matters which are required to be reported. So let us try to revise them quickly. Maintain silence please, focus. Right. First of all, let us talk about applicability. Is auditor of every company required to report on CARO? No. So they initially told that CARO is applicable for all companies including a foreign company. What do you mean by foreign company here? The company which is incorporated outside of India but it is having a place of business in India. Even they are also required to comply with CARO. But however, a few companies are exempted from applicability of CARO. Which are that companies which are exempted from CARO? Banking company, insurance company, section 8 company, 1% company, small company, and a private limited company. What is that? And a private limited company subject to fulfillment of 4 conditions. All 4 or any 4? Any of the 4? All 4. So if a private limited company, if it fulfills all the 4 conditions which we are about to discuss now, then for that private limited company also CARO will not become applicable. If CARO is not becoming applicable, who is happy? Both will be happy. Company also will be happy, auditor also will be happy. Why? Because auditor need not put the extra effort, company need not provide extra information to the auditor. Both will be happy. So but what are that conditions which are required to be fulfilled by a private limited company for CARO to not become applicable? Number 1, it should not be a subsidiary or holding of a public company. So neither you should have, if you are a private limited company, neither you should have a holding company which is a public company, neither you should have a subsidiary company which is a public company. So neither your subsidiary nor your holding should be a public company. Number 2, the paid up capital along with reserves and surpluses should not exceed, that means it should be less than or equal to 1 CR as on what date? As on the balance sheet date. Throughout the year, what is the situation doesn't matter. As on the balance sheet date, the total of the cumulative balance of paid up capital and reserves and surpluses shall not exceed 1 CR. Third one, the borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. Not just as on the balance sheet date, throughout the year, at any point of time, What should not have happened? The borrowings from banks and financial institutions should not have exceeded 1 CR. Not on the balance sheet date, guys, at any point of time during the financial year. And last one, total revenue, including revenue from discontinuing operations, shall not exceed 10 crores. As on the balance sheet date or at any point of time. Revenue is a cumulative figure. It is not a one point, it is not a balance, it is a cumulative figure. When I say revenue, that will consider for the entire financial year. So if all these four conditions are satisfied, then for such a private limited company, CARO will not become applicable. Understood? See, there are some specific things which you have to keep in mind. I think you all know that. You might have done multiple questions and all. I don't want to go into that applicability and all. We will directly go to the reporting requirements, or should we touch upon it slightly? Okay, so when it comes to paid up capital and reserves and surpluses, all kinds of paid up capital will be included. All kinds of paid up capital will be included. Equity share capital, preference share capital, everything will be included. If there is any calls in arrears or calls in advance, that adjustments you have to do. When I say reserves and surpluses, all kinds of reserves will get covered here. Capital reserve, revenue reserve, will get covered here. If you have any debit balance in the P&L, that you can adjust it against credit balance in the reserves. Even after adjusting against the credit balance of the reserves, if you have any excess debit balance in the P&L account, that you can adjust it against paid up capital. When I say adjust, will you go and adjust in the balance sheet? No, we are adjusting it for the sake of calculation. Okay, next. When I say borrowings, when you are calculating borrowings, all kind of borrowings will get considered. Short term, long term, even credit card outstanding balances also will be considered. Secured, unsecured, everything will be considered. And only borrowings from banks and financial institutions is required to be considered. Other borrowings will not be considered. Okay. And from a bank, if you have a borrowing with the same bank, if you have a fixed deposit also. Say for example, with a bank you are having 50, with a bank we have 1.1 CR of borrowing. With the same bank you have 30 lakh worth of fixed deposit. Should I consider the gross value or I should take the net value? You have to take the gross value. Don't net off the assets and all. Next, is the limit of 1 CR for each bank separately or cumulatively for all banks and financial institutions put together? Cumulatively for all banks and financial institutions put together, the borrowings should not have exceeded 1 CR. Finally, total revenue. In the total revenue, this total revenue figure is exclusive of taxes. But you have to be careful. If the given figure is already exclusive of taxes, don't deduct it once again. So the given the figure you should take is exclusive of taxes, and if there is any trade discount, that you can reduce it, right? Then, so this is what the things you need to keep in mind. And one more thing, audit, if you are conducting audit of, in case if the company is having branches, so principal auditor is there, branch auditor is also there, separate branch auditor is there. Now for checking, see for example, for principal auditor, we will calculate the limits for the entire company. For the branch auditor, to decide whether CARO is applicable or not, should we calculate the limits for branch separately? No. We will calculate the limits for the company as a whole. If once CARO becomes applicable for the company, the principal auditor and all the branch auditors are required to comply with CARO. And in case of holding companies, they prepare two sets of financial statements: standalone financial statements, consolidated financial statements. According to which financial statements we have to calculate the limits? Standalone financial statements. On the basis of standalone financial statements, you have to calculate the limits. And for audit of consolidated financial statements, CARO is not applicable except one clause, clause number 21. Only you are required to report clause number 21. Rest of all the clauses are not required. Right. So these are the things which you need to keep in mind for checking the applicable limits. Now we will talk about the points which are required to be reported. Okay. Right. So what and all are the different matters which are required to be reported? So let us try to pay attention now. First thing, which is relating to property, plant and equipment. See, when I say property, plant and equipment, tangible, intangible, work in progress, everything will get covered here. So when it comes to property, plant and equipment, there are 5 things which auditor is required to see and comment. So what is the first one? Maintenance of records. Are they asking auditor to maintain the records? No. They are asking the auditor to check whether management has maintained proper records regarding property, plant and equipment. From that records, we should be able to know quantitative details. What do you mean by quantitative details? Number of the assets, and along with that, from that records, we should be able to understand situation, location of that PPE. So that is first one. We need to check whether proper records are maintained or not. Number two, physical verification. Are they asking auditor to do physical verification? No. They are asking the auditor to check whether management has done the physical verification at reasonable interval. Now, what could be the reasonable interval? Once in 3 years. Fixed assets are not required to be physically verified every year. The reasonable interval for verification of the for physical verification of fixed assets is once in every 3 years. So you need to check whether these fixed assets are physically verified by the management at reasonable intervals. On that verification, whether any discrepancies. What do you mean by discrepancy? Differences are found out. If yes, whether they have been properly dealt with in the books of accounts or not, we need to comment. Third one, specifically they talk about immobile properties. When I say immobile properties, land and buildings will get covered here. So they say that in respect of any immobile properties, you have to get the title deeds of all the immobile properties. Land and buildings, to take the balance sheet, check all the land and buildings, ask the management to give the property deeds. Check whether the title of the immobile property is in the name of the company. That means in the property title deeds, the property should have been registered in the name of the company. In case the title of the immobile property is not in the name of the company, then you are required to give some details. You are required to report some details. What you are required to report? Description of the property. What is the gross carrying value? It is held in whose name? If not in the company's name, whose name is there? And the person in whose name that property is there, is he a promoter? Is he a director? Is he your employee? And for how long the asset has been held by the company, and what are the reasons why it is not yet transferred in the name of company. So these things are required to be reported. Next, revaluation. Fourth point is regarding revaluation. We need to check whether the management, whether the company has revalued its property, plant and equipment. See, when I say revaluation, revaluation could inflate the figures, or revaluation could even reduce the figures also. So we need to check whether the management has done the revaluation of its PPE. If yes, we need to check on what basis they have done the revaluation. Did they do the revaluation on the basis of a registered valuer? Valuation should be done by registered valuer. According to that, revaluation should happen. Revaluation should not be done according to whatever management thinks. It should be done on the basis of valuation done by a registered valuer. And if the change before and after revaluation, if the change is 10% or more in the aggregate of carrying value of each asset, then even that change also you are required to mention. But here there is one minute thing which we need to pay attention. Say for example, I am verifying land and buildings. In the land and buildings, I have 3 buildings, building 1, building 2, building 3. Before revaluation, after revaluation, I will give you the figures. Building 1, 100. Before revaluation, after revaluation, it is 87. Building 2, 50. After revaluation, it is 57. Building 3, the value is 100, and after revaluation, the building is 108. The building after revaluation, the value of the building is 108. Now you tell me for which asset I am required to report the amount. So for which asset I am required to report the amount. They told if the change is 10% or more. If you see here, for building 1, the change is 13. For building 2, the change is 7. For building 3, the change is 8. Individually, if you compare, here 13% change is there. Here 14% change is there. Here 8% change is there. But you are not required to report any amount. Why? Because they say if the change is 10% or more in aggregate of each class of PP. For the entire PPE, you have to calculate what is the aggregate. So what is the value of entire PPE, entire land and building before revaluation? How much it will come to? 250. What is the value after revaluation? 243 or 2? 242. Sure about it? Okay, I do believe you. But it is wrong. 245, I guess. 245, no? Yeah, whatever year, less than 10% it will be. No? 242 only. Okay, fine. Sorry, my mistake. Calculator told. Good. 242. So here if you see, for the entire class of land and buildings, what is the change here? 8 CR only, which is hardly less than 10% of 250. So nothing, no amount is required to be reported. Understood? So that is what the fourth point. Now coming to the fifth point regarding which you are required to report is Binami transactions. You need to check whether any Binami transactions have been initiated. Have they been started freshly, or already they are undergoing or pending against the company for holding any Binami properties? If yes, whether the company has appropriately disclosed. Once again, they are not asking auditor to disclose the Binami transaction details. They are asking the auditor to check whether company has disclosed the Binami transactions in their financial statements or not. Clear? So first matter which is required to be reported under CARO. What is that? PPA. Under PPA, 5 things. Number one, maintenance of proper records. Number two, physical verification at reasonable intervals. Number three, titles of immovable properties. Number four, revaluation. Number five, Binami transactions. Next. Coming to the next one, second item, inventory. So regarding inventory, what you are required to report. Here also physical verification. So here also I need to check whether management has done physical verification of the inventory at reasonable intervals. What is reasonable interval for inventory physical verification? Once in every year. Here you can't say once in every 3 years. Once in every year, the management should do physical verification of their stock. And on doing that physical verification, you have to comment coverage and procedure is appropriate. Whatever procedure has management has followed, whatever coverage they have done for that physical verification, is it appropriate according to the size of the company? And also, in case if the discrepancy is 10% or more between the stock which is physically lying and between the stock as per the records, if the difference is 10% or more, once again not for each item, once again for aggregate of each class of inventory, then you are even required to report that amount of discrepancy also. Here the classes of inventory, if I say raw material is one clause, work in progress is one clause, finished goods is one clause. So for each class you need to check what is the difference, what is the difference as per books and what is the difference as per physical stock. If that difference is 10% or more, then you are required to report it. Next, second one is regarding working capital loans. This point says that you need to check whether your client company has taken a working capital loan, that too in excess of 5 crores, that too giving your current assets as a security. The second point will become applicable only when your client has taken a working capital loan. If your client has not taken working capital loan, no reporting here. And your client has taken working capital loan, but the amount should be more than 5 CR. If the working capital loan is less than 5 CR, no need to report. And your client has taken working capital loan, amount is more than 5 CR, and for that should be a secured one, for which they should have given their stock current assets as a security. If that is the case, in case if you have taken the working capital loan on the basis of the current assets as security, you are required to submit quarterly stock statements to the bank regarding your stock position. Now they have put a responsibility on the auditor to check whatever stock statements which are getting submitted by the company to the banks, is it matching with the books of accounts? That means, are they submitting genuine stock statements or fake stock statements? That you need to check and give a comment. Understood? Clear and comfortable, everybody? So second point, that will become applicable only when client has taken a working capital loan, that too in excess of 5 crores by giving a security of current assets. Clear? So inventory, 2 points, physical verification and working capital loan, checking of the stock statements. Now, third point talks about investments, guarantee, security, loans or advances, once again, which are given by company, not about accepted. They are talking about receivables given by the company. So when it comes to this, we have 6 points. So what are that 6 points? Number one, you need to check whether during the year has your company provided any loans or provided advances in the nature of loans, or they have given any guarantee to any other entity. Basically, I need to open their ledgers and check whether the company has given loan, advance or guarantee to other entities. If yes, I need to do some bifurcation and do the reporting. So what bifurcation I have to do is, if my client company has given loans to others, say for example 10 entities they have given the loan, out of that I need to identify which entities are subsidiaries, associates and joint ventures. Say for example, out of these 10 entities to whom my client company has given loan, 2 are subsidiary companies, 1 is associate company, 1 is a joint venture. So 4 such companies are there which are having a relationship of subsidiary, associate, joint venture. And we have remaining 6 companies which are not a subsidiary, not a joint venture, not an associate company. Now I need to identify for these 4 companies put together, what is the aggregate amount of loan given during the year, and what is the balance outstanding as on the balance sheet date. The same thing have to calculate here, what is the aggregate amount of loan given for these other entities and what is the balance outstanding as on the balance sheet date. Simple bifurcation we have to do and report it. However, this point is not applicable for those entities whose principal business is to give loans. Sir, anyhow for banking company, this banking company CARO itself is not applicable, no? Whose principal business is to give loans? Banking company. But for banks, CARO itself is not applicable, no? But NBFCs we have, yes. NBFCs CARO will become applicable, but this point will not become applicable. Understood? Right. So first point is bifurcate and report. Second point, this is one very much similar to 143 subsection 1 we have seen. On whatever terms and conditions your client has given the loan, are they prejudicial? Are they harmful against the interest of the company? Like giving the loan without interest, or the rate of interest is very less than the market rate, or giving unsecured loan. So these are all terms and conditions which are prejudicial. We need to check it. Repayment. So I need to check the company has not just like that given the loan and ignored it. They need to prepare one schedule of repayment. When interest has to be paid, how much repayment have to do, what is the installment amount, they have to calculate. And I need to check whether the payment is received, payment of principal, repayment of principal, payment of interest is getting received within due dates regularly. If not, I need to check whether I need to check that only. Third point, I need to check whether the receipts are regular. On or before the due dates I am receiving my installments or not, I need to check. So first I need to check, is there a schedule of repayment and whether the payments are regular. Fourth point, if there is any amount which is overdue, that too which is overdue for more than 90 days, I need to check what steps are taken by the management for recovery of that amount. They are not asking auditor to take any steps for recovery. They are asking to check whether management has taken any steps for recovery of that principal and interest amount, whatever it is. Next, fifth point, rescheduling or extension of the overdue loans. That means this point says that previously company has given loan to somebody. In the current year, that loan has fallen due. 24-25 is the current year. In the current year, loan has fallen due. That means the due date has fallen in the current year. If the due date has fallen in the current year, what they should have done? They should have collected the amount. But instead of collecting the amount, what the company is doing is they are extending. They are extending the due date. They are telling to the people, no need to pay in the current year, pay it in the next year. Or what they are trying to say is they are giving a fresh loan to the same person, and that person is using the fresh loan, repaying the old loan, but new loan will continue once again. Should they do it or should they not do it? They should not have done it. So check whether these kind of transactions are done. Loan has fallen due in the current year, but instead of collecting the money, they have either renewed it, extended it, or have given the fresh loan to same person. If the answer is yes, we need to check what is the aggregate amount which has been given. What is the aggregate amount of such dues which are renewed, extended, or fresh loans given, and even you have to calculate percentage. Basically, you have to calculate what is the total loans given during the year. Say for example 100 CR. Out of that 30 CR is in the form of extension or fresh loan to the same person. 30% it will come. That percentage also you have to mention. However, this point is also not applicable if the company's principal business is to give loans. Here also they are talking about NBFCs. Next, demand loans without repayment period. So you need to check whether your client company has given the loan without mentioning any repayment period. We generally call them as demand loans. So is that good thing or bad thing? That is a bad thing. Without mentioning the repayment period, just like that, if they are giving the loans, that is not acceptable. That is against the term. That is against the terms of the. That is prejudicial to the interest of the shareholders. So, in case if your client company has given any loan which is repayable on demand or without mentioning on repayment period, without mentioning any repayment period, we need to specify what is the total amount of such demand loans, and also we have to calculate percentage, like the way we have calculated the total percentage with the total loans, that percentage also we have to calculate, and we need to mention separately what is the amount of such a demand loan given to promoters and related parties. So these are the 6 points which are required to be reported regarding investments, loans, and guarantees. What are they? Number 1, first we have to do segregation for related parties for other than related parties. Number 2, we need to check repayment, terms and conditions. Third one, schedule of repayment. Fourth one, overdue for more than 90 days. Fifth one, renewal or extension or giving the fresh loan to the same person. Last one, demand loans are getting given there. Clear? Next. Fourth point is also talking about loans, investments, and guarantees made by the company. This is also loans given by the company only. In case if the company has given any loan, they can't give whatever amount they want. There are certain calculations, certain limits which are given under section 185 and 186 of the Companies Act. We need to check whatever loans which are given, those are in accordance with the limits of 185 and 186 or not. Then, in case if your client company has accepted deposits, fifth point is regarding deposits. In case if your client company has accepted the deposits, we need to check provisions of section number 73 to 76 have been complied with or not. With regard to acceptance of deposits, even RBI also will give guidelines. We need to check whether that guidelines of the RBI has been followed or not. In case if there is any guidelines given by company law board or any court or tribunal, even that guidelines are also followed or not. If any kind of non-compliance is there, the nature of that contraventions is also required to be reported. Understood. Next. Sixth point is regarding maintenance of cost records. See, not every company is required to maintain cost records. Only those companies which fulfill the criteria given under section 148, they are required to maintain cost records. You need to check whether your client company is fulfilling the criteria given under section 148. If yes, whether that cost records are maintained or not. Then, seventh point is regarding statutory dues. What do you mean by statutory dues? Those amounts which you are required to pay because of some law, like PF will come there, ESI will come there, GST will come there, income tax will come there. So all these things will come under statutory dues. For the purpose of reporting requirements, statutory dues are divided into two categories: undisputed, disputed. What do you mean by undisputed? There is no differences. Yes, there is no conflict between the departments and authorities or the client. If you receive a notice from the income tax department, will that be considered as dispute? If your client has received income tax notice saying that they are required to pay 1 lakh worth of income tax, can we call that as dispute? No, just receiving the notice is not a dispute. If you are challenging that notice, you received a notice and you say, no, I'm not liable to pay, you are challenging, then the dispute will start. Just receiving a notice will not be considered as dispute. Similarly, a mere communication with the tax authorities, you got some doubt whether on this income tax will become, whether on this GST will become applicable or not. You went and consulted respective tax officers. So can that be considered as dispute? No. A mere representation, a mere receipt of notice can't be considered as dispute. In order to consider it as a dispute, there should be conflict. There should be conflict, then only dispute will start. So when there is undisputed dues, that means you are required to pay some amount. You also acknowledge it. You don't have any difference of opinion, but you still did not pay. So regarding that undisputed dues, what you need to check? So I need to check whether company is regular in depositing all the undisputed statutory dues. That means regular in the sense paying on or before the due date. If not, no, your client has not paid any statutory dues. Regarding that, dispute is also not there. Then you need to comment those amounts, those things, those arrears of outstanding statutory dues as at the last day of financial year concerned for a period of more than 6 months. From the date they become payable till the balance sheet date, if they are still not yet paid, and if they have remained overdue for more than 6 months as on the balance sheet date, only those amounts you are required to report. Say for example, 24-25 financial year, what is the balance sheet date? 31st of March 2025. For the month of January 2025, the client is required to pay 5 lakh rupees of GST. He did not pay it till 31st of March 2025. No dispute is also there. Is this amount required to be reported? Is this amount required to be reported? No. Undisputed statutory due, agreed, but it is not outstanding for a period of more than 6 months as on the balance sheet date from the date it becomes payable. Some amount, say for example, this client is required to deposit some TDS for the month of July 2024. But he did not pay it till 31st of March 2025. Amount is 10 lakh rupees. Is this amount required to be required to be reported? Yes. Undisputed statutory dues which remained outstanding for a period of more than 6 months as on the last day of the financial year. Yes, you are required to report it. Understood. So this is regarding undisputed. Sir, what if there is a dispute? I'm not paying some statutory due. Why I am not paying is because there is a dispute. There is some case going on. In respect of disputed dues, you need to comment on two things. You need to mention in your CARO report what is the amount involved in the dispute, the forum where the dispute is pending. What do you mean by forum? Before which authority the case is pending. Like, is it pending before officers? Is it pending before commissioner? Is it pending before tribunal? Is it pending before High Court or Supreme Court? That forum also you are required to mention. So till now, how many reporting requirements we are done? 7 we are done. So first one, PPE. Second one, inventories. Third one, loans, investments, guarantees. Fourth one is also regarding loans and investments. Fifth one, deposits. Sixth one, cost records. Seventh one, statutory dues. Now coming to the eighth one, which is talking about disclosure of undisclosed income. Now what does this point say is, during the financial year, some income tax assessment happened. Your client has undergone some income tax assessment. What do you mean by income tax assessment? Might be your IT return has been taken up for scrutiny, or income tax raid might have taken place. So some kind of assessment has taken place under Income Tax Act. As a part of that assessment, your client has offered some undisclosed income. Previously, he has hidden some income from the taxation. That income he has offered it. He surrendered the income now. Okay. So now what they say here is, if you are disclosing undisclosed income to the tax authorities, that alone will not be enough. This income you might have excluded from your books of accounts also. Whether the same has also been brought into the books of accounts or not, you need to check. So basically, in order to fulfill this reporting requirement under this point, first you need to check whether any tax assessment has taken place. If no tax assessment, no reporting requirement. Yes, tax assessment has taken place. Then you need to check whether your client has surrendered any previously undisclosed income. Yes. Then you need to check, have they brought the same also in the books of accounts? Whether not, if not, then you are required to give a negative comment here. Understood. Next, ninth point. See, till now they have given so many points regarding loans given by the company, but they did not speak about loans which are accepted. So now they have given even regarding loans which are accepted by company. So here also they say 6 things. Number 1, whether your client company has made a default in payment. What do you mean by default? Two things. Not even paying. You did not pay altogether. That is a default. You paid it after due date. That is also default. So you need to check whether your client has made any default in the repayment of the borrowings. If yes, you need to provide the amount of default and the period of default, that to each lender wise. Lender wise, not total amount. For each lender, what is the amount you have made default and how long, what is, for what period you have made the default, lender wise you have to report. Next, willful defaulter. Whether your client has been declared as willful defaulter by any bank or financial institution, you need to comment. How can you get to know? Credit reports, CIBIL scores. If you check that, then you will get to know whether your client has been declared as a willful defaulter. Third one, purpose of term loan. So that means your client will go and tell some convincing purpose to the bank and get the loan. But after getting the loan, instead of using it for long term purposes, he will instead of using it for the set purposes, he will start using it for other purposes. So many companies have gone bankrupt because of these things. So they get the long term loans stating some purpose, but they use it for some other purposes. So as an auditor, because of that, bankers' interests are getting affected. To protect the interest of the banker, they have put a responsibility on the head of the auditor to go and check whether your client has taken any long term loan. For that, they might have set the purpose. For that, you need to go through the loan document and you need to check what, for whatever purpose they have got the term loan, whether they are using it for the same purposes or they are misusing it. Next, usage of short-term loan. This is also more or less same like previous thing. Today, access to short-term loans is very, very easy. Even you also can get the short-term loan by personal loan by showing your PAN card. So getting of short-term loans has become very easier, but whenever you get the short-term loan, that you should use it only for short-term purposes. You should not invest it in long-term purposes. That will result in something called liquidity crunch. Liquidity crisis will be there. So you need to check whether your client has got any short-term loan. In case if they have got the short-term loan, are they using it for short-term purposes or they are using it for long-term purposes? You need to check and give a comment. And loans taken to meet subsidiary company needs. Whether your client company has taken a loan, but not for meeting the expenses or obligations of your client company, but for meeting obligations of subsidiary company. So that you need to check it. And not just that, whether your client company has taken loan for your client's purposes only. But for taking the loan, you have to give something as a security, no? Have to offer some security. What your client has done is, whatever shares they are holding in the subsidiary company, that they have pledged it and got the loan. For the company's requirements only, they got the loan. But the security what they have offered is, they have pledged the shares which they are holding in subsidiary company. What did they say in the previous point? Your client has got a loan not for the client's purposes, but for meeting the obligations of subsidiaries. That also you are required to report. Your client has taken loan for your client's purposes only, but by pledging the shares of subsidiaries. That also you are required to report. Understood? So 6 points regarding repayment of loans. What are they? Number 1, default in the repayment. Whether your client has been classified as willful defaulter, whether the term loans were used for the intended purposes, whether short-term loans are used for long-term purposes, in whether your client company has taken any loan to meet the subsidiary company's needs, whether your client company has taken loan by pledging the securities of subsidiaries. Clear? Next. Coming to the next thing, utilization of IPO or FPO. So whether your client has raised any money by way of IPO or FPO. When they are raising the money by way of IPO or FPO, they will mention the purpose. So now I need to check whatever money they have raised by way of IPO or FPO, whether they are using it for intended purposes. How you will get to know about the purpose? Exactly. So you have to go through the prospectus. In that, purpose will be clearly mentioned. You have to get through the prospectus, understand the purpose. Then you need to check whatever money that has been raised, whether it is getting used for stated purposes. If not, you need to report delays, defaults, and even subsequent rectification. What do you mean by subsequent rectification? Initially they have misused it, later they have compensated it. Even that subsequent rectifications are also required to be reported. Under the same point, we have one more thing: preferential allotment or private placement. What is the difference between IPO, FPO, and private placement? IPO is allotted for everybody. Private placement is also a method for raising the funds, but shares will not be allotted to everybody, to only a specified group. So in case if the company is raising the money by way of private placement or preferential allotment, there also I need to check whether the provisions of section number 42 and 62 have been complied with. Whatever money that you are raising for by way of IPO, FPO, there also prospectus will be there. We need to check whether that amount is used for the said purposes. If not, provide the details for what other purposes they have used it, how much amount they have misused it, that you are required to report. So this is what regarding utilization of IPO and FPO. Now, coming to point number 11. So what is that? Reporting of fraud. See, whenever you came across a fraud, you are required to fulfill some reporting requirements already under 143 subsection 12. In some cases, you are required to report to central government. In some cases, you are required to just report to the audit committee or board of directors. In addition to reporting requirements under 143 subsection 12, if you come across any fraud, you are also required to comment under para number 11 of CARO. So what here I have to report? Let us see whether any fraud by the company or on the company has been noticed or reported during the year. If yes, nature and amount involved in the fraud has to be indicated. So is any fraud noticed or reported during the year? If yes, you have to comment under para number 11 of CARO. What is the nature of the fraud? What is the amount involved in the fraud? But there is a difference in reporting requirements under 143 subsection 12 and para number 11. The differences are: under 143 subsection 12, if you read the phrases, they say if you have a reason to believe. What they say? If you have a reason to believe. It need not be a noticed fraud, it need not be a reported fraud. If you have a reason to believe, you are required to report that fraud. But to fulfill the reporting requirements under CARO, they use the phrase the fraud which has been noticed or reported. That means proven fraud. Even if you have a suspicious fraud also, you are required to report it to the central government under 143 subsection 12. But under CARO, you are required to report only noticed or reported frauds. Point number 1. Second point. See, under CARO, under 143 subsection 12, if the amount involved in the fraud is 1 crore or more, you are mandatorily required to report to central government. Whether that 1 CR is material or not, you should not check it. You are conducting audit of a Reliance Industries Limited. You came to know 1 CR amount of fraud. Is that material? But still, are you required to report to the central government? Yes. But while reporting under CARO para number 11, you are required to report only material frauds. Immaterial frauds, you can ignore it. Understood? So two important points of difference. Under 143 subsection 12, it need not be a proven fraud. Even if you have reason to believe also, you are required to report under 143 subsection 12. But only noticed or reported frauds are required to be reported under para number 11 of CARO. And under 143 subsection 12, whether material or immaterial, you have to fulfill your reporting requirements. But under CARO, you are required to report only material frauds. Clear? Next. Whether any reports under 143 subsection 12 has been filed by the auditor in form number 884. So whether any of the auditors, see whatever reporting requirements we have seen under 143 subsection 12, they will not just become applicable to company auditor, they will also become applicable for cost auditor, they will also become applicable for secretarial auditor. So I need to comment in my CARO whether any of the auditors have submitted ADT4 under 143 subsection 12, and also whether there are any whistleblower complaints during the year. If yes, whether auditor has considered that whistleblower complaints or not. So these three things are required to be reported under para number 11. Important, many times asked. Next. 12th point is regarding Nidhi company. In case if your client company is a Nidhi company, then you are required to fulfill reporting requirements under para number 12. What if your client is not a Nidhi company? You can simply mention that the client is, we are not a Nidhi company, you can say, but in case if your client company is a Nidhi company, then you are required to report on 3 points. Number one, whether they have a net owned funds to deposits in the ratio of 1:20. That is, for every 1 rupee of net owned funds, they can accept a maximum deposits of 20 only. Next, whether Nidhi company is maintaining 10% unencumbered term deposits of whatever total deposits they have received, 10% they should keep it in unencumbered. That means without any charge, without offering it as security for any loan, they have to keep it in the term deposits. And also whether if there is any default in payment of interest on deposits or repayment thereof any period, if so, the details thereof. Have they made any repayment of interest or repayment? See, in this point here you have to give only comment. You need not mention what is the amount of default, what is the period of default. You need not say, just you have to mention whether any default has taken place. That's all. Why? Because they would have already mentioned, they would have already given the details in point number 9. If you go to point number 9, repayment of loans, first point what they say, whether your client company has made any default in repayment of loans. If yes, what is the nature of, what is the amount and period of default. Lender wise anyhow they will give. So that's why in para number 12, once again, you need not give amount and period details and all. Just you will mention the fact whether default has been made or not. That if you mention, it will be enough. Details anyhow we will give it in para number 9. Understood? Next. Related party transactions. You need to check whether your client has entered into any related party transaction. If yes, we need to check compliance with the provisions of section 177 and 188. And also there are so many disclosure requirements as per accounting standards regarding related party transaction, whether all that disclosure requirements are met or not, that also we need to check it. Next, 14th point, you need to check whether your client is having appropriate internal audit system, and that internal audit system should be commensurate with the size and nature of its business. Even internal audit is also not mandatory for all the companies. It becomes applicable only as per section 138, a few companies which fulfill criteria. If yes, you need to go and check whether your client is having internal audit team, and size of the internal audit team should be matching with the company. Companies Reliance, they have an internal audit team. In the internal audit team, 2 people are there. Is it matching with the size of the company? No. Next, whether the reports of internal auditors for the period under review were considered by the statutory auditor. Sometimes as a statutory auditor, you can use the reports of internal auditor for your decision making, for your opinion. Have you used the internal audit reports? That also you need to give a comment. Next, whether your client company has entered into any non-cash transactions, that too with the directors. If yes, you can't do it in whatever manner you want. You should have complied with the provisions of section 192. So you need to check the compliance there. Then coming to the 16th point, NBFC. This point will become applicable if your client is a NBFC. If not, you can mention the fact my client is not a NBFC. Reporting requirements under this clause will not become applicable. So when it comes to NBFC, 3 things. You need to check whether your client is required to get registration under 45 IA of Reserve Bank of India Act. If yes, whether they have obtained registration or not. Number 2, whether your client company is conducting any non-banking financial or housing finance activities without obtaining a certificate of registration from RBI. Third one, whether your client company is a core investment company, CIC. After becoming NBFC, if you fulfill some conditions, you will get one status, CIC. So you need to check whether your client company is a CIC. If yes, whatever conditions which are required to be fulfilled to enjoy that CIC status, they should continue to fulfill it. So long it is not just like one time you have complied with the conditions, you got CIC status, then you can't ignore it. So long as you enjoy that CIC status, you have to continuously fulfill that criteria. So whether that criteria is getting fulfilled or not, we need to check. Not just that, see here what they say here is, once you are NBFC, if you fulfill some 10 conditions, you will get the status of CIC. After becoming CIC, if you fulfill some extra 5 conditions, you will get something called exempted CIC status. So if my client is just a CIC, I need to check compliance with that 10 conditions. If my client is a exempted CIC, I need to check 10 plus 5, 15 conditions compliance. And if my client is a very bigger group, so many subsidiary, associate, joint venture, holding companies are there. As a part of that group, is there only one CIC or is there more than one CIC? Like holding company is also a CIC, subsidiary is also CIC, associate is also CIC. If the group contains more than one CIC, we need to mention how many number of such CICs are there in the entire group. So that is what third point is about. So three things regarding NBFC: whether they require registration under 45 IA of the Reserve Bank of India Act, whether the client is doing any non-banking financial or housing finance activities without obtaining certificate of registration, whether your client is a CIC or exempted CIC. If yes, they are fulfilling the conditions. And as a part of the group, do you have one CIC or more than one CIC? If you have more than one, mention that figure. Next. 17th one, cash losses. Whether your client has made any cash losses in the current financial year and also in the preceding financial year. When I say cash loss, do I mean loss as per the statement of P&L? That is not loss as per the statement of P&L. You have to take the profit or loss figure from the statement of P&L, add non-cash expenses, reduce non-cash incomes, then you will get a figure called cash loss. They should have made a cash loss in the current year also. They should have made a cash loss in the previous year also. Then you are required to report it. Understood? Clear? Next. Resignation of auditors. You need to check whether any of the statutory auditors have resigned. If yes, you need to consider because of what issues, what objections, or what concerns they have resigned. That issues you have to consider once. Then information about financial assets and liabilities. See, this is one such points. Basically, as an auditor, we will express our opinion on historical financial information. But this one point is an exception. So now, because of inserting this point, because of this point number 19 in CARO, we are required to express our opinion on future also in one aspect. So nothing but what they say here is you need to give your opinion. You need to give your opinion regarding one thing. What is that opinion is? Whatever whatever liabilities are there, liabilities are there, as on the balance sheet date, which fall due within a period of 1 year. From the balance sheet date, whatever liabilities which fall due within 1 year, basically whatever current liabilities are there, is the company is in a position to pay that current liabilities, or do they have any material uncertainty? You are required to give a comment. Is the company in a position to pay their liabilities which fall due within 1 year from the balance sheet date, or is there any doubt, is there any uncertainty? Sir, and on what basis I have to give this comment, sir? So on the basis of considering various information, what and all information you have to consider? On the basis of considering the ratio analysis by doing aging and expected dates of realization of financial assets and payment of financial liabilities. Basically, when you will collect from your debtors, when you are required to pay to your creditors, you should do that aging analysis and all other information accompanying the financial statements. So, and also by sitting with the board of directors and getting understanding and knowledge of what are their plans for future. So by on the basis of all this, by doing ratio analysis, by doing aging of financial assets and financial liabilities, by using information accompanying the financial statements, by using all this information, you are required to comment: is the company in a position to pay their liabilities which fall due within 1 year from the balance sheet date, or is there any material uncertainty existing? But however, this is also not a guarantee. This is just an opinion, and this opinion can even go wrong also. Clear? Next, 20th point, unspent CSR expenditure amount. Now, as we all know, a few companies are required to spend 2% of their average net profits of the last 3 years on social welfare. So regarding the social welfare, there are certain things which we need to check and give a comment. So first point, they say whether in respect of other than ongoing projects, the company has transferred unspent amount to a fund which is specified in Schedule 7 to the Companies Act within a period of 6 months of the expiry of the financial year. So what is this is? Say for example, there is one company X Limited. They are required to spend some 2 CR on corporate social responsibility for the financial year 2024-25. So now they need to plan. I'm not telling they have to spend, they have to plan. So they have to plan how they are going to spend this money within 6 months from the end of the financial year. That is on or before 30th of September 2025. They should have plan ready. I'm not telling they should have spent it. They should have projects ready. Say for example, the company has decided out of this 2 crores, 50 lakhs they will give it as a donation to old age home. Some another 50 lakhs they will give it as a donation to orphanage. And using some 80 lakh rupees, they will do a construction of a school in a rural area. These plans they have, these projects they have by 30th of September. But 30th of September is over, balance amount what they have to do, they are not able to determine. Total how much amount they have to spend? 2. how much they have decided, for how much amount they have a project, 1.8 cr. Balance at 20 lakh rupees, they are unable to decide a project. So what they should do is they should transfer this amount to a fund which is specified under schedule 7. Under schedule 7 they have specified various funds like prime minister national relief fund, so pm cares fund, like that some funds they have specified. To that fund you have to transfer the money. That means if you are unable to decide what you are going to do within 9 months, give that money to the government, government will take care of it. Once the money goes to the government, there is no coming back. Once you transfer to the fund, there is no coming back, that will be handed over to the government. So you need to check if any such amount is there relating to other than ongoing project, whether that has been transferred to a fund specified in schedule 7 within 6 months or not. That is the first point. Now in the second point, what they say here is, whether any amount remaining unspent under 135 subsection 5 pursuant to ongoing project, relating to ongoing project. So now we have plans ready for how much amount? 1.8 cr. So out of that 50 lakhs they want to give a donation. They have written a check, give the donation. 50 lakh rupees they have to give a donation to orphanage. For that also they have written a check and gave it. 80 lakh rupees they want to use it for construction. But construction is not going to happen in a day or two. It is going to take a significant amount of time. So 80 lakhs is there. Yes, I have a project also ready. I'm going to use it for a specified project. But it will take some time for me to spend this amount. Till the time you spend this money, you have to keep it in a separate bank account. You have to keep this money in a separate bank account. You are not required to transfer anybody. Just go to the bank, open a CSR account. In that CSR account, you have to keep the money, and that money will be under the control of company only. Who will spend that money? Company only will spend the money. For what purpose they will spend the money? For that project only they will spend the money. But just they have to segregate that funds from normal funds. That's why they are asking you to keep it in a separate bank account. Whether they have kept it or not, I have to check and give a comment. Clear? So two things regarding CSR expenditure. Number one, if you don't have any project ready within 30 days from the end of the financial year, transfer it to fund. If you have a project ready, but it is taking some time to spend, then you have to transfer it to a separate bank account. Whether these requirements are fulfilled or not, I need to check and give a comment. So these are all the matters which are required to be reported. 20 matters are there. Now we have one more matter, which is 21st matter. This 21st matter will come in the audit report of consolidated financial statements. So basically what they try to say here is, if you are conducting audit of the consolidated financial statements, say for example X Limited, which is a holding company, it is having some 4 subsidiaries, it is having some 2 associates, 1 joint venture. Now this company will prepare consolidated financial statements. For these consolidated financial statements also audit report will be given. In that audit report, CARO heading will be there, but in that only one point will be commented. So what is that is, this auditor, whoever is conducting audit report of the consolidated financial statements, he should go through individual audit reports of the entities whose financial statements are included in the consolidated financial statements. I told 4 subsidiaries are there. These 4 subsidiaries will have their own standalone financial statements and they will have their audit reports. Now go through that audit reports. Check whether in any of their audit reports, in the CARO section, whether any point contains a negative remark. Whether any point contains a negative remark. Say for example, out of 4 subsidiaries, subsidiary number 2, in that, okay, so in that second subsidiary company which is included in the consolidated financial statements, in that audit report, when the auditor has gone through it, he found that in the CARO report, somewhere in the paragraph number 11, there is some negative comment. That respective auditor has given some negative comment regarding fraud. So now what you should do is, in this audit report on the consolidated financial statements, you should say so and so company, say for example Z, so and so company Z, which is a subsidiary, in their audit report para number 11 contains a negative remark. So that you have to give where in the audit report of consolidated financial statements. So basically you have to go through individual audit reports of those companies which are included in the consolidated financial statements. Check in their CARO reports whether any point contains negative remark. If yes, give that details in the audit report of consolidated financial statements. Understood? Clear and comfortable everybody? So with this we have completed all the 21 matters which are required to be reported under CARO. Okay, right. And these 21 matters are required to be reported whether you have a positive comment or you have a negative comment, it doesn't matter. So it is mandatory to report all these matters. And in case if you are giving any negative remarks, explain the reasons also. In case if you are unable to comment on any on this of any of this point, even you have to mention the reasons why you are unable to comment on this point. What circumstances led you to not express an opinion on that point, that also you are required to mention. Understood? Right. Next. So this also we are done. Now what else is left out from this chapter? Essay 299. Small standard is there. We will try to complete it. So essay 299, which is going to talk about the concept relating to joint audit of financial statements. So what is the meaning of joint audit? Guys, maintain silence. So what is the meaning of joint audit? So when more than one auditor is conducting an audit of single entity for the same financial year, for this having the same scope of work, and for the same financial year also, for the same duration, for the same entity, and also having the same scope of work. So when more than one auditor has been appointed to conduct audit of the same entity for the same financial year and also having same scope of work, that engagement we call it as audit, so joint audit engagement. So I will give you a few examples. You let me know whether that will fall under joint audit engagement or not. Say for example, there is, I will give simple examples anyhow, I will give you some complicated examples. There is a company X Limited. There is a principal auditor who is conducting audit of the entire company, Mr. A, and there is a branch auditor, Mr. B, who is conducting audit of only one particular branch. Can this be called as joint audit assignment? Why? Because more than one auditor is there for same entity for same financial year, but the scope of work is different. Principal auditor will have his scope as entire company. The branch auditor will have only branch as a part of his scope. So that's why this can't be called as joint audit. So now let us say, for example, for a company for one financial year, there is a person, Mr. A. But this is a company X Limited. For the financial year 25 or 24-25, Mr. A has been appointed as company auditor. For the same financial year, Mr. B is also appointed as a company auditor only. Can we call this assignment as a joint audit assignment? Yes. Why? Because more than one auditor for the same financial year and also having same scope of work. Yes, this will 100% fall under joint audit definition. So there is a firm for the financial year 24-25. There is a firm ABC & Co which has been appointed as a company auditor. For the same financial year, Mr. Z, an individual chartered accountant, has been appointed as a company auditor. Can this also be called as joint audit? Yes. So more than one auditor. Basically, that could be more than one individual person, more than one audit firm, or it could be a combination of individual and an audit firm. So all the assignments we call them as joint audit assignments. Will joint audit assignments really happen? Yes, they do really happen. So Reliance is a joint audit. Auditors, partners from two different firms will sign the audit report of Reliance Industries Limited. So you can find it here also in the audit report. We go at the bottom. See here, two firms are there: DTS and Associates LLP, SRBC and Co LLP. Two different firms, partners from two different firms have signed the audit report. And even banks like this corporation, statutory corporations, SBI is a joint audit. So 14 joint auditors, 14 audit firms would have signed the audit report of SBI. So yes, joint audits do really happen, but it is not a statutory requirement. There is no law, no standard which says so and so company has to undergo joint audit. They did not say that. It is completely the decision of entities. Okay. So now, once again, as I have told, any business will not spend the money unnecessarily unless they find some benefits. If some entity is undergoing joint audit, they will definitely do it only when they find some benefits in it. So what are the benefits of joint audit? What are the advantages of happening of joint audit? So number one, sharing of expertise. See, work done by one professional, the same work done by two professionals. So more expertise you will have. Work will get completed in less amount of time. Ultimately, the client is going to get a better service, and also it will promote healthy competition between the auditors. Generally, that will not happen. Unhealthy competition will get developed. But yeah, so it is a opportunity for promoting healthy competition and better quality of the service. So all these advantages are there. So that's why the companies are opting for joint audit. But this joint audit will not just come up with advantages, it will also come up with many disadvantages. What are the disadvantages? You have to share your fees. Very good. You're on point. All right. All right. So fees will have to be shared. Nothing but previously last year you have done audit single handedly. You have got 10 lakh rupees of fees. But this time you have to share the audit with another auditor. Will they cut half, 5? No, that's not how the things work out. So last year, if you have got 10, current year you might get 7, 7, 8, 8. That's how you get. But whatever it is, the share is getting reduced, no? So sharing of fees. And also, see, this is the disadvantage from the chartered accountant's perspective. So lack of cooperation. If I have to put it in simple terms, the joint auditors might not cooperate with each other. They have something called superiority complexes, ego complexes they will have. And sometimes you might have to face the consequences because of others' mistake. If other joint auditor has done the mistake, you might be required to face consequences. So like this, joint audits also will come up with disadvantages, but advantages are outnumbering the disadvantages. So that's why the companies are opting for joint audits. Okay, we understood advantages and disadvantages. Now let us try to understand how the work mechanism will be, how the joint auditors will perform the audit. See, when I say joint auditors are appointed, for Reliance, two joint auditors are there. Does that mean both will do 2 times audit separately? That is not the purpose. So when the joint auditors are appointed, generally how the work will happen is the work will be divided among joint auditors on some suitable basis. On some suitable basis, the work will be divided. On what basis work will be divided? So it could be on the basis of geographical locations. Like one joint auditor is saying, I will look after the northern states. One joint auditor is saying, I will look after the southern states. Or the work could be divided on the basis of period of the financial statements. One joint auditor is saying, I will look after first 6 months. Other joint auditor is saying, I will look after the next 6 months. Or it could be divided on the basis of products. If the company is doing multiple products, on the basis of businesses also they can divide it. Like one person might say, I will look after petroleum and retail segment. Other person can come and say, I will look after telecommunication and fashion segment. And it could also be divided. What else? What did I say? Three things. Identified units, that means businesses only. On the basis of geographical locations, that also we have covered. On the basis of a period, one more thing should be there. Products also I have covered. Product or businesses is same. On the basis of elements of financial statements. So basically, you do assets, I do liabilities on the basis of items of the financial statements. Also, you can divide it. So whenever joint auditors are appointed, the first thing what they do is they divide the work among themselves on some suitable basis and get the work done. Now, what about responsibility? What about responsibility? There are two kinds of responsibility. There will be separate responsibility and there will be joint responsibility also. So when there will be separate responsibility, generally you are dividing the work on some suitable basis. Each joint auditor will be made responsible only for the work which was allocated to him. Like the work was divided on the basis of period of the financial statements. Auditor A was doing first 6 months, auditor B was doing next 6 months. That is, A is doing from April to September, auditor B is doing from October to March. They have done the audit, they have given their opinion. They have, both of them have given unmodified opinion. Later it was found out that there was one big fraud which has taken place in the month of August, which auditors were not able to identify. So who has to face the consequences? Only A has to face the consequences. So generally, in normal circumstances, whenever the work is getting divided, each joint auditor will be held responsible for work which was allocated to him, work which was divided to him. But however, there are certain circumstances. In certain cases, there will be joint responsibility, which means everyone has to face the consequences. So what are the circumstances where there will be joint responsibility? Number one, in case of those work which is undivided, if some work is not divided, either they might have forgot or intentionally they did not divide it, whatever could be the reason. If some undivided work is there, if in that work something has gone wrong, who has to face the consequences? Everybody, all the joint auditors have to face the consequences. Number two, decisions taken by all. If some decision has been taken by all the joint auditors collectively and something has gone wrong in that decision only, who has to face the consequences? Everybody, all the joint auditors have to face the consequences. Third one, matters which are brought to the notice of the joint auditors, of all the joint auditors. Like say for example, 14 joint auditors of SBI. They are all conducting the audit. They have divided the work on the basis of states. On the basis of states, they have divided the work. Now these 14 joint auditors have created a WhatsApp group. They have created one WhatsApp group for the purpose of communication. So one of the joint auditor to whom Andhra Pradesh state is allocated, he found out some big fraud. in the AP state. So now what he has done is he did not keep that to himself. He has posted in the WhatsApp group. He has posted in the WhatsApp group. And everybody has seen it also. Everybody has seen it, but no one took the action. When they are discussing about the opinion and all, the person to whom that AP location was allocated, he remained silent. He told, I will give unmodified opinion. Since he is only not taking action, rest of the people also told, okay, we are also have no objection, we will also give unmodified opinion. Now everybody gave unmodified opinion. Finally, the fraud was exploded. So now who has to face the consequences? All. Sir, it was allocated to one person, no. But that useless fellow did not keep that mistake to himself, no. He has brought it to the notice of everybody. Since he has brought it to the notice of everybody, who has to face the consequences? We all have to face the consequences. That's what I told, one of the disadvantage. So there will be uncertainty for liability. Because of others' mistake, you should also face consequences. And also one more area where you have to where all the joint auditors will have responsibilities in checking whether the financial statements are prepared as per applicable financial reporting framework or not. So whatever financial statements are there, whether they are presented properly, schedule 3 is fulfilled properly or not, disclosures are given or not, that is a responsibility to check on everybody. Even if you allocate that work to someone, but still some mistake is there, who will be held responsible? Everybody will be held responsible. Finally, whatever audit report you give, whether that audit report is as per relevant statute or not, basically whether your audit report is as per standards on audit or not, checking that is also responsibility of everyone. So if in that matter something wrong happens, everybody will have to face the consequences. So these are the few cases where there will be joint responsibility. Understood? So what are they? Number 1, undivided work. Number 2, collective decisions. Number 3, matters brought to the notice of everyone. Number 4, financial statements are as per applicable financial reporting framework. Number 5, whether audit report has been given as per the standards, as per the relevant statute or not. So in these cases, there will be joint and collective responsibility. Now, what about opinion? How the opinion will be framed? See, 14 joint auditors are there. Will they give 14 audit reports? Generally, what will happen is once audit has been completed, all the joint auditors will sit together. They will have a mutual discussion. They will arrive at one common conclusion. A kind of voting will happen. So now when they sit for discussion, they will say which opinion you wanted to give. Say for example, all the 14 joint auditors say, I don't have any objection, we all want to give modified opinion. Then what they will do is they will prepare one single audit report. On that audit report, all the 14 auditors will sign and that report will be issued. But sometimes what will happen is there will be conflict. So 13 people out of that 14 people, 13 people are saying unmodified opinion. One person is there who is a freshly qualified chartered accountant. He wants to show all his talent in the first audit only. So he found one misstatement that is not material. He also know it, but he, as I've told you, know that urge will be there. So in the initials, yeah, superiority complex will be there. He is going to everybody. He is going to all other auditors and arguing. Hey, I found a misstatement. It is a material misstatement. I will give modified opinion. I will copy from the appendix. I will say, I will show all my caliber and all he is saying. The rest of the 13 people are telling, I know you are a, rest of 13 people are telling, you are a bacha, we know. Just now you came to the industry, but that is not a material misstatement. Don't get so excited. We can give unmodified opinion, they are saying. But this fellow is not agreeing only. So what he should do? Should he go with the majority? No. So here there is no democracy. There is no rule of majority in the case of opinions and all. So what they have told is, in case if there is any difference of opinion, no one is required to go with the majority. Then what he will do, sir? Then what he will do is those 13 people, they will give one audit report which contains an unmodified opinion. And this one person, what he will do is he will give a separate report in which he will give a modified opinion. So now there will be 2 audit reports for the same entity. And whenever they are giving 2 audit reports, in each audit report, they should give a reference to the other report. Like 13 auditors are giving unmodified opinion. No, in that report, they will say, this is our report of 13 auditors. There is one more audit report which is given by one joint auditor. Similarly, this one joint auditor also will say in his audit report, this is my report. We have 13 other joint auditors. They have given another report. References should be given. So now the management will get 2 audit reports. Which one they have to circulate? Both they have to circulate. Very good. This will be circulated to every shareholder. Which one shareholder has to rely? Leave it to his headache. That he will decide. See, we will pass on the information to the shareholder. He will read the report. He will read 13 people have told unqualified opinion. One person is telling qualified opinion. He will read the reasons also. Basis for opinion, reasons will be there. So he will decide. If he also feels that is a bullshit reason, he will tear that opinion and throw it in the dustbin. Rely on the 13%, that rely on the opinion of the 13 people only. So let the shareholder decide what he wants to rely. but the company will have a responsibility to share the audit report of both. Okay, so let the shareholder decide which information he wants to rely. So this is what regarding opinion, and this is what regarding circulation. Now, one more last thing which we need to understand is special considerations. There are some special things which you have to keep in mind when you are conducting the joint audit. There is no such special thing as such. Whatever normal things which you do individually, that you have to do collectively in the case of joint audit. See, when we are doing normal audit, if we are the only auditor, we are doing the audit, we develop a audit strategy, audit plan, audit program and all. If joint auditors are doing, what they should do, everybody should participate. Engagement team and engagement partners and key engagement team members from all the joint auditors should participate. They should have one collective audit strategy, they should have one collective audit plan, and they should have collective audit program. Now, as we have seen, auditor is required to prepare engagement letter and share it with the client. Do you think all the 14 auditors will give separate engagement letters? No, all of them will collectively prepare one engagement letter and give it to the client. And also, there are various matters on which management is required to give written representation. Do you think management will give written representation separately for all the 14 joint auditors? No, they will address all the joint auditors collectively and give one single written representation. And also, these people are dividing the work among themselves. No, they have to document it on what basis they have divided the work, which person has taken care of which work. If there is any undivided work, what common audit procedures they have done in that undivided work that you need to do. And there should be one proper work allocation document. That work allocation document should be signed by all the joint auditors. One copy should be even given to those charged with governance also. Clear? So that is what some special things. Basically, whatever things you do independently, that you have to do collectively if you are doing a joint audit. Like as you see, the engagement partner and other key members of the engagement team from each of the joint auditors should be involved in the planning. They should establish one joint overall audit strategy, and they should discuss and develop one joint audit plan. So while developing that audit plan, they need to consider these areas. This is a repetition from audit strategy planning and program. The same points will be there in the audit strategy planning and program. There I will try to link it if the time permits. But anyhow, this is same thing will be there. There you will find, while establishing overall audit strategy, there are 5 things which you need to consider. The same 5 things we will consider while establishing audit strategy in the case of joint audit also. But we do it collectively. That's the only point of difference. Then each of the joint auditor should consider and assess the risk of material misstatement. Everybody should do risk assessment and communicate what risk they have assessed with others. And they should discuss and document nature, timing and extent of audit procedures for common and specific allocated areas. They should get one common engagement letter, they should get common management representation letter, and the work allocation document should be signed by all the joint auditors, and it has to be communicated to those charged with governance. Understood? That's all. This is what regarding SA 299. With this, we have completed audit reporting chapter.